Uh, you want to ask question? I thought somebody wanted to ask question. Okay. All right. So we talk about the fact that there was financial state. You want to talk about financial state, there are elements like assets, liability, capital or equity. And these three things, that's what we use to form what we call the accounting equation. So we talk about what assets were, what liabilities are obligation, then the equity or what we call capital. Now we say that you can be asked to calculate for any of these three elements if you know two. So with this some equation, assets equal to capital plus liability, and you can just change the equation. The rest. I think that is the basis or the beginning or the introduction. And I think I don't want to go much into that because assets, we talk about fixed assets or non-current assets. We also talk about current assets, and we also talk about liability in that order. So please just look at this. We want to continue today and move forward. Today, we want to just start what we call the users of accounting information. Users of accounting information. Just a minute. When we talk of users of accounting information, we are talking about a group of people who use the accounting information to make decisions, because we talk about the fact that when we are defining accounting, so accounting is the art or is the process of collecting data, analyzing it, summarizing, interpreting transactions and events that can be expressed in terms of money. For which people? For people or users to make an informed economic decision. So it means that there are some people that matter when it comes to accounting information or financial statement. So whenever you are preparing financial statement, there are people who are in mind that you are preparing it for. And that's what we call users. So when we talk of discuss about 5 users of accounting information or maybe 3, then these are the people that we are coming to discuss. So, and whenever you talk of any user, you have to know the specific information that they will need from the financial statement. We have various financial statements. We have what we call statement of financial position, which we call the balance sheet, which show the assets and liabilities of a company. Then we have the statement of financial performance, which shows the sales, the profits, and loss that the company is making. Then we have cash flow statement, we have disclosures, and so we have various information that we will be preparing. But when you talk on the users, one of them is potential and existing investors. So investors are one of the users of accounting information. So when I talk of investor, there are people who want to invest or buy shares or put their money or resources in a company. In a company, they are investors. But before they buy shares or before they invest their money in the company, the first thing that they want to look at the performance of the company. How much share and how much dividend are you paying on the shares that you are the dividend that you declare for a year. You look at all this in the financial data or statement of financial position, they will see the dividend per share that was declared last year. So when they get your financial statement or your statement of financial position or income statement for about 5 years or 3 years, these investors can now go to, last year, how much were the dividend? Oh, they pay 80 pesos per share last 3 years. Okay. Then the last 2 years, they pay 1 CD. Then they say they pay, oh, okay, this company is doing well. It's like every year they're able to increase their dividend. Then it's better I buy shares from them. You go and take huge money, buy shares in maybe commercial bank or Guinness Ghana. Based on the data, the financial information or the state of financial position that you have monitored for about 3 years. And so that every year it's like their dividend per share increase. So you have bought so much share, about 60,000 shares, and you are giving them huge money, thinking that in the subsequent years your investment is going to yield. So that is one of the users. So you see, existing investors, those who are already shareholders, they also need information, and the potential are those who are yet to buy the shares in the company. The existing investors, the reason why they also need, they want to know how much profit are we making this year. So, okay, this year the company made a profit of so much. Okay, then we are anticipating that our dividend should also increase because this year the profit has increased about 20%. So they also monitor. So that is what we mean by users. So this is one of the users of financial or accounting information, potential and existing investors. Now, they are interested in a number of, they are interested in the company's ability. So because they are investors, they put money in investment. So when they buy the shares, they want the company, they are interested in the company's ability to pay back their money or their capital, the investment that they have made. They are interested. They want the company. So the existing potential investors are yet to purchase shares or invest their monies in the business. The existing or potential providers of risk capital are concerned with. So you see, always you have to know what they are concerned with the risk inherent in and the return provided by their investment. They need information to help them determine whether they should buy the shares, whether they should buy, hold, or sell their what shares. So you see here, that's why the existing investors, this is some of the decisions that they make. And for the potential, they are now coming, so they need information to do the analysis and see, okay, this company, then we can go and buy the shares in it. Now, existing shareholders who are already shareholders of the company, if they also look at the company and say, for the past 2 years, we are getting loss, or maybe we are not getting any increment in our dividend. Should we still hold our shares in the company, or we should sell and get our money back? So these are some of the decisions. So the existing shareholders, they will be thinking of, should we sell our share and go get our money and leave this company, or we should still let the shares be in the company and get it? And all these decisions that they make is from the financial information or statement that you prepare, the company prepared, that will help them to be able to take such decision. So for them, shareholders or investors, they are interested in all the financial statement. They are interested in the statement of financial position, that is the balance sheet, because from there, they will be able to know the assets that the company is having, the assets. Oh, okay. Even this company is huge. They have a lot of assets. Look at the vehicles that they have. Look at the building. They have multinational assets. Oh, okay. Then it's not risky. But even if anything, they can sell their assets to pay out. So they are interested in your financial position. That's where they will see the asset. When they look at the financial position, they also know the kind of liabilities, obligation, car or the liabilities that you are having as organization. So you see that when they see that your liability is too much, it will scare them that this company that is having a lot of debt. No, it's not good. So these are some of the decisions that they make. So please, the users of accounting information, when you are talking about them, potential and existing shareholders or investors are part. Yeah, one of them. Are you with me? I hope you are there.
Yes, please.
Yes, sir, we
So
are there.
good. If you want to ask question
Yes,
to
sir.
if you want to ask question, you can go ahead and ask your question whilst I'm teaching. Now that's first one. Now let's look at another users of accounting information. Employees of the company. Now you see, employees are people or individuals who actually carry out the physical operations or rendering the set of services. Employees and their representatives group are interested in the information about the stability and profitability of their employers. They are also interested in information which enable them to assess the ability of the enterprise or the company to provide remuneration, retirement benefits, security, and employment opportunities. So you see, whenever you are in any employment or any establishment, whether in a company or whatever, you are everybody, every employee. The number one priority is your salary, your remuneration. How much is this company going to pay me at the end of the month? Is it enough? Can it sustain me? So you look at the profitability, the remuneration, the amount that they are going to pay. Sometimes will the company be able to pay anything like compensation when I go on retirement? Job security is also concerned to employees because employees don't want situation whereby you are in this job or this company or you have been employed. 3 months the company has collapsed. Then you have to go and look for another job. No, that is very frustrating. So when employees are in any work, they always think, in as much as they think about how much salary they are going to get, they also think about job security. So some people they accept certain jobs not just because of the pay, but they want the job security so that at least you are there permanent. You know that for the next 5 years, 10 years, or even after your retirement, this company can sustain, can be here till retirement. Some people that is enough for them, job security. But there are some people, some job will pay you very well high, but it's contract 3 months, the job cease, then you are jobless. So people look at this, and you can get these things from the financial statement. If the company prepares financial statement, when I talk of financial statement, it's not one thing. I'm talking about the balance sheet, the income statement, the profit and loss, and the cash flow. If the company prepare faithfully to represent as it is, then you can, based on the financial data information that have been prepared, to predict whether this company is going to be there for a very long time or whether the company is going to collapse. Because if you look at the statement that have been prepared for this year, and the company's liabilities are so much than their assets, the company has a lot of obligation. Their profit is very small, and that it tells you that this company is not viable. This company is shaking. It's not. It's shaking. It can collapse at any time because if the liabilities are more than the assets, when the lenders or the creditors come for their investment, the company has nothing. That company is not something that if you are there, you should be. You have to be thinking twice. So, but when you look at the financial statement, I say, oh, you have so much assets. The current assets are so much. If you look at the current assets, plenty. The liability is small. Oh, okay, this is and that one they will get more profit. The profit always every year the profit they increase the profit by 20% margin. And you see that this is a company, dividend has always been increasing. Oh, this so when you are there as an employee, you feel like this is a company or this is an organization that you have saved. You can be there. That is and that's the decision that you take as to whether you have to continue to be there as an employee or whether they will be able to pay retirement benefit or whether the job the employment opportunity or whether you can be there. All these decisions are made from accounting information, the statement that is prepared. Employees can look at that statement, the figures, and all that, and predict how the future of the organization can. And that is the purpose of accounting. We provide quantitative data for users to make an informed decision about organization. So whether you continue to hold your shares in the company, whether you continue to be an employee in the company, whether they are all based on financial or accounting information. So that is why accounting is very important in an organization. Lenders or suppliers or other trade creditors. These are also users. They are also users of accounting firm. They are not employees of the firm, but these are people who give financial assistance like banks. They are lenders. They give companies money, loans, huge money. Suppliers, people who supply raw material, they give raw material to companies on credit and decide to come for the money. They are trade creditors, and so all these people are also there. They are also one of the users because before a bank will give a company a huge loan and say pay it in 20 years or 10 years time, before a supplier will sell goods on credit to an organization, first they need to assess the credit worthiness of their company. And what the banks will do is that bring your financial statement. That's all, because as a collateral, they will look at your statement of financial, they will look at the assets that they can secure the loan on. So, okay, we are giving you 20 billion Ghana cedis or maybe 10 billion cedis. You have to pay 20 years time. By 20 years, you finish. But if you are not able to pay or if you default, what assets can we sell? What properties can we sell so that we can get our money? The bank will look at. So when you prepare when they look at your financial positions, your financial your balance sheet, oh, okay, this asset, they have a lot of premises, buildings, they have plenty. Oh, do we can give you the loan because they are going to use these assets as collateral, and while they see that you have them, they can give you the loan. That is so lenders or suppliers and creditors, before they will sell goods to you on credit or give you raw materials and other things for you to use on credit, they first they look at how profitable the company is. If they look at the financial statement for, oh, this company has been doing well, they always make profit. Oh, they don't have a lot of liabilities. They always pay their creditors on time and the rest. When they look at the financial statement, all this information will be available because in your financial statement, you will show that you have to, this man, you have to show your assets and your liabilities. And the liabilities are those obligations that you have to settle at later date. That are the creditors and other things. So if they see that you don't have enough creditors or the liabilities are not credited, then they can say, oh, you are credit where you can sell goods to you and the rest. So um when you are discussing, look at it from that point of view that there are people who provide financial support to companies and institutions, and therefore everybody will want to assess suppliers and other things want to assess the credit worthiness of the company before they will supply or before they will give that loan to you. So that is that. I think you can. This one is very simple. You can explain some of these things. I'll give you the material. This material, I'll send it to you so that at least you can take your time and read. But I'm just trying to give you how the conceptualization of everything. So when you read, you understand what we are talking about. Now, government and other agencies also need accounting information. They are also users. For government and other agencies, government need use accounting information for so many reasons. One is to determine through the financial information, the government will be able to know how much profit that the company is making, because every company is supposed to pay tax to government, GRA, and the tax is based on your net profit. So the net profit that is declared based on that the government is going to know how much tax he or she is supposed to, the company is supposed to pay to the government. So the government will ask you to prepare to declare your net profit for the year. So you know whether the net profit or the tax you are paying is adequate or not. So government use the accounting information to take those decisions. So for taxation purposes, for governmental agencies are also regulatory organizations set up by government. The other regulatory organization that makes sure that there are certain things that the companies are supposed to do where they are complying to the laws, standards. Sometimes some companies are doing a lot of things, getting money, and they are polluting the environment because of their activities. You see that the waste and even the pollution in the air, some of the industries. So the government look at the financial statement, see the kind of preparation or the thing that what they are doing towards helping the environment to also become user friendly, or how to make the environment safe. So in your financial statement, there's a budget. There's need to assign. Let us see what you are doing to make the environment sustainable and other thing. That one too, the government want to look at that one, and that's why sometimes you see some of these corporate entity doing corporate social responsibility. Sometimes I think that why that these companies are doing it is requiring something that companies need to do, because some of the companies, their operation poses some threats to we the citizens. So you see that MTN, well, I must say they have built some 6 unit block for a certain community. MTN had donated it, and we are crapping. Oh, MTN for them, yeah, do the. You see, yes, beside those things, the activity, even this max, this MTN, this their pool max that they relate in towns long. Sometimes they radiate certain kind of emission, and research has shown that when you stay closer to those things for about 10 years, those the MTN max and those, sometimes there are some effects, not now, but there are certain things. But they are getting their money by the citizens or the community or the people. We are inhaling some of these things and other things. And because of that, there's a social responsibility, corporate social responsibility that they need to also pay back to society. And that's why sometimes you see some of these organizations spending so much in building hospitals, so much building schools. Sometimes Guinea's Ghana, when they are playing football match, that they say they will take care of all the life, they will sponsor it for the live coverage for all the nation to watch. And so they have done well. Yeah, there's a reason. Corporate social responsibility. Government need to, and the government monitor it through the accounting information. Customers also are one of the users. Customers. No customers, there are people who are interested, or they buy the products, or those who patronize the product of the company. Now, customers have an interest in the information about the continuance of an enterprise, especially when they have long-term involvement with, or the dependent on the enterprise. Why we are saying that customers are also like employees. They want to know whether the company can supply them their items anytime that they need it. So when you are in business and you are working with a certain company who provides certain services or certain products for you to also sell to your people. So you're a customer of that, and you always want to monitor their financial statement and see whether they are not going to collapse now, whether they can be in existence for long, whether they can provide you with all the goods that you need to get at right quantity at right time. So all these things, they're also interested. Then the public, the general public. We, the general public, are also interested in the financial statement, because enterprise affect members of the public in a variety of ways. Like I was saying, for example, enterprise may make a substantial contribution to local economy in many ways, including the number of people they employ and their patronage of local suppliers. So you see, financial statement may assist the public by providing information about the trend and recent development in the prosperity of the enterprise and the range of its activities. So general public also look at the company and say, oh, they are coming to open new branch here. So it means that there's a likelihood that when you look at the information, so next year we open another branch in this one, and that's why we are working. Oh, okay, then we can employ people. People will start making arrangements to get employment there. They also look at the financial statement, will also let the public know the kind of activities that they do, and therefore, if they can do business with them, if you look at the kind of product that they produce, you can also decide to say, oh, this raw material can you sell to them and the rest. So The general public also, and the general public also get to know. Once you get to know what the business is doing, and then you can also get to know or be interested in whether their products you can buy some, or even whether you can buy share, or whether you can do. So these are the uses of the financial statement. Then we have management of the organization. They also need a financial statement. The management, not about management, we are talking about the board of directors, the finance directors, the uh, sales manager, and the management of the company. They also need a financial statement because they are people who plan, who organize, direct, and take all the decisions for the company. Now, the information will help them to determine the next step, what they should do, whether they are doing well or not, because they require the three major financial reports. They are interested in the performance of the business as to whether dividends can be paid to shareholders. They need that. So when they get a financial statement, then they will be able to okay, we can pay dividends so much or not. They also need they must provide stewardship to owners of the company on the continuous survival and how the business is being effectively managed. So that's the statement of financial position. They need information. They have to give accounts to the shareholders. So you gave us this access, three cars when you entrusted the companies to, but now we have added another three. So now the companies are vehicle, motor vehicle are now five instead of three. The buildings we have opened another two branches here. We are done this. So these things is an data information you are giving to shareholder, and that will let them know that yeah, the management is also efficient. So these are the users of financial information that we have. If you have questions up to this point, you can ask before we move on to other concepts. Yes, the floor is open. Questions, comment, contribution, they are welcome. If you have question, if you have comments, if you think you are everything is okay, to let me know so that I move on. Users of accounting information. I hope it went well. I hope it's okay.
Yes, dog. Yes, dog. I think I can hear.
Good.
Good.
Yes, please.
Then we can move on. So let's move on to now that we have finished with the users of accounting information. Let's move on to another conceptual framework that we need to talk about. That is something that every accounting student you should know this. But when you say you have done accounting, normally I don't teach this, but because especially those who have done accounting, and even there are some of you who have done accounting, but some of the concepts you have forgotten. You have forgotten. I know. Like I was saying the other time. Accounting is something that which you the account, hey, my accounting process me accounting. But I say beside you no like hey, they are told soon. So because of that, there are certain things that you need to. But once you say you have done accounting, there are certain basic things that at least you should remember. So let's look at accounting concepts and principles. Accounting is about rules, principles that we use. So if you don't understand some of these concepts, it will be difficult for you to appreciate the calculations that we are going to do. So all the calculations, accounting, every calculation that we do, everything that we do in accounting, whether debit or credit, it's influenced by one of these concepts. Which means that as we move forward, all the things that we were doing, we can link them to one of these concepts that we are, and that's what we call accounting concepts and principles. Some book will call accounting concepts, conventions, axioms, tenants. They are all the same thing. They are rules and regulations that governs how accounting transactions should be treated. So they are universal principles. When you go to China and you go to US, if an item is supposed to be debit, wherever you take it to, is debit. If it's credit, credit. These rules and regulation make you or bring about what we call uniformity in accounting. That Everywhere we go, we treat accountants all over the world. Treat that items the same. So whatever we are doing here, this thing we are learning here, it is not only in Ghana accounting. No. When you go to US, when you go to Germany, wherever you go and say you are doing accounting, asset is asset, liability is liability. You debit, you credit, it's the same thing everywhere. And that is why it makes accounting very interesting, because it is universal or generally accepted principles, standards that is applicable worldwide, everywhere you go. So if you do accounting here, with this knowledge you are getting, when you go to any country in the world, say you have done accounting, and you it's the same thing that you are talking about. So you can practice. So let's look at some of the uh, accounting concepts. And you see, you should understand, because these concepts are like the 10 commandments in the Bible. Those who are Christian. When you close your eye, or when you wake up early in the morning, and if you what an accounting mention, if they mention a concept as accounting teacher or what, you should be able to offhand. You can book more this. After accounting, it should be at your fingertips, because that is the base. And I have done them, but the foundation for accounting is about the concept and the principle, because the principle that you are going to apply in doing the calculation. So once you understand the principles, the rationale behind whatever you are doing, then you can apply. In fact, accounting, yeah, but you don't. Those of you chew and pour, it's not about the accounting chew me. I can memorize figures. No, it's not about memorization of figures and format on your eye. No, just understand the principle. That is how we do things. And once you apply the principle, madam, you don't have problem. The accounting you need, but you just understand the principle. That's all. Now, one of the principles that I see, each of the principles have a justification in the financial statement. So you see that in a question, normally the question, what is it? If you say discuss or explain some accounting concept or this accounting concept, it's not like you're just coming to talk about it that it is and good. No, once you finish talking about what the concept, at least you should be able to tell us something in accounting, something that is done in accounting, which justify or which is based on this principle you are talking about. So we talk about business entity concept. Then you have to let us know something about accounting that we do that justify, that is the justification. So the question is discuss maybe accounting concept and explain in that's give a justification of each of the concept. That justification means that if you say business entity is this, okay, we understand what is done in accounting that satisfies business entity or that. So you have each of the concept has their justification. When you take the financial statement too, when you take whether the income statement or the statement of financial position, you will be able to get the justification for each of the concepts. So that's where we are going now. So please take your pens and this thing. And, yeah. Okay. Now let's move on. And there's one thing. That's my style. I don't know whether it's okay. I'm not reading almost everything. I'm just explaining the concept for you to understand. Then you go and read it. I hope you are okay with that. That is
Yes,
how I
please.
teach.
It's going well.
Yes, please.
Yes, because if I do all the reading for you, when you are there, what are you going to read? So some people just read everything. No, that's not me. We just speak to the point. We explain the concept. We explain everything for the person to understand. So at your own leisure time, then you'll be reading to get more information. So when you are looking at the slide, you see that I'm not reading almost everything, but whatever I'm explaining is about the point. That is how I want to, and that is the most important reason why you have to always join the lecture, because some students sometimes may think that why you get a slide, we have the material, and that is it. It is not enough, because there are so many things that I say in the lecture or in my explanation that I can give, which might not necessarily be in the slide. These are just points, but in the lecture, I'm able to explain, give a lot of illustration for you to get a conceptualizing understanding very well. So I mean, when you are writing, you don't need to memorize everything here. You don't need to chew this point, but you can still use your own idea and explain and communicate for me to understand that, yeah, you really understand what you are talking about. And this is also going to help the fact that in exams, I don't expect you to all be writing the same thing. If it's only the slide, then you think that all of you are going to produce the same thing. But with the explanation, people will understand it in their own way, citing the exam. But you see that when you read somebody's point, another point, and you see that they are all from different dimensions, but making the same point. And that is how the beauty of learning, and that's how we should learn at this level as intellectuals. Okay. So the first principle, okay, just give me a minute. Just read through. Business entity. I'm back. Have you read through?
Yes, please.
So if I ask you what is business entity concept, what will you say? I know you have done accounting before, so you know. Yes, go ahead.
This I would say is where the owners of the company, you see
Uh-huh.
them as a different but separate body from the business. So whatever they do or say doesn't affect whatever they say, whatever they buy doesn't affect the business so much. So if the business, the company buys it, then it's for the company. If the owners, if they buy something to be used by their family or even the owners, it's not for the company. That's how I.
Good. That is perfect. Perfect. Now, you see how this you have explained the principle very well. That is yes. Go ahead. The person that's raised the hand. You to say your point. Oh, I'm listening. Let me see. Let me see. Those whose hands are up. Okay. Let me do it this way. Okay. So the explanation you give is perfect. Now, can you give me a justification in accounting? What do you think we do in accounting that satisfy this um, um, principle? Yes. Oh, who explained? The person who explained. Go ahead. Yes.
Let's say I'm a owner of a company and
Uh-huh.
I buy a car for my husband or my wife. It's not for the
Uh-huh.
company. So it should not be recorded as the asset of the company.
Okay. Yes. Any other?
Hello, Doc.
Uh-huh.
Please also when the owner of a business take goods or cash from the business for his or her personal use, it's
Uh-huh.
regarded as drawings and should not be part of the business transaction.
That's good. So you see, that is the justification. So always there's item called drawings. That drawings you see in the financial statement when we are doing financial statement, we are listening to capital less drawings. That drawings that you have, where is the drawing coming from? It's because of business entity concepts. Sometimes you see the business entity concepts, there's a legal. So let's now start. So, like you said, the business entity concept assumes that activities of a business are separate and distinct from that of the its owner. So, if you are an owner or you are an entrepreneur, so the business is here, this is your business, and the artificial human being you are here. Even though you are using money to start the business, once the business is established and start the operation, There's a legal separation, thin line, legal separation between you and the business. The business is seen as artificial human being capable of managing it, and you too, you are a natural human being. So, from the point of view of the business, you are different from it. That is the first thing that you have to always remember when you are talking about business entity or business entity concept. We call it as a legal separation, thin line between the owners of the business and the business itself. So the business has its name, and the business can sue somebody, and also can be sued without the owner being taken to court. So when you have a company, let's say Ben Company Limited, is Ben Company Limited is different from me, Ben. So if the company does something default in payment, they will not take me personally to court. They will take the company to court. If the company fail, the assets and the assets of the company can be sold to pay off. But me, I will not go to pay. That is how it is run. So because of that, when somebody to default, the company can also take somebody to court. That's why we say that the business is distinct from its owners. And because of that, the owner should be very careful when you are getting transactions. Because in most cases, what we see is that, like somebody said, once you open a company and you are managing it, there's a possibility that your personal expenses can be added to that of the business, and that is dangerous. So, this business entity concept will help us, to separate the personal expenses and liabilities of the owner should not be charged to that of the company. And that is the reason why there is what we call drawings in business. Because when you have a store like a supermarket, this is the owner. You are selling the things. Now in the morning, every morning, you go and take 1 tin of milk, take a Milo, and put this asset. You take Milo, sugar, everything. And because you think the business, but you don't pay, then you go and what? You go and go to owner, you know, mother, my cookie, we don't mother. And then every day you are take any item you take from the store because you think it is your own store, you don't need to pay for it. That is not how this business entity can violate that principle. So no, because it's part of when we have run accounts, all the amount of things that you have taken that you didn't pay, we will classify them as drawings. So anytime you see drawings in accountants, we are talking about the amount of part of your capital because you gave the money. So part of the capital that you are eating. So what we expect is that when you take item, because you are seen at a natural human being, there is also human being. You expect that if you take the item as 10 cents, pay for it. Because there is what we call at a point in time, you assess the company. I say, business I'm starting, I say me young for Sobia, and then Miami still me one. Ref said your money you are eating it. The Milo and the item that you are taking for personal use, you are not paying for it. It is your drawing. So if you really want to know whether you are getting profit, then you have to take care of the drawings and add it to whatever before you. That is what we mean by business entity. So it is the principle that says that business is different from the owners, and therefore the transaction of the business should not be mingled with that of the owner. The business can be sued and also be sued in its own name without the owner taking to, that is the business entity. Now, one of the justification is the drawing. Another one is capital, which is credited. So you see, when we start document, you see that anytime you have capital accounts, capital is the amount of business that the owner used to start a business. But why is it that your own money, but it is credited in the business, like it's a liability? Why? That is also a business entity concept that is bringing up. So let me demonstrate that to you. You see, when you look at this analysis that I made here, there's a thin line between the business and the owner. So the business see itself as I am artificial, I'm capable of managing my things. So if you set me up as a company, I have a management, I have everything, I can manage myself. So you, the original owner, you are my establisher, you establish it. But at a point in time, I have to give accounts to you that, oh, you use $1,000 to set me, but I have gotten 2,000. So you say, oh, I have done well. But if I can do that, so from the point of view of the business, the owner is a creditor. That is why capital accounts always credited, even though it is the person's own money you are using to start a business. It's not assets in the company point of view, because the company sees itself as I am a human being, though I'm artificial. You are establishing me, all right. But the money, all the money you are pumping to this business, from me, it's a liability. It's a liability to me, because at a point in time, you come that you are coming to take your money. I have to give an account to you, and that's why always capital is always having a credit balance, because it's a liability. All liability have credit balance. So capital is, so the company is going to say, okay, in my company bank accounts, this is a company bank accounts. When the owner brings the money, the company is going to debit the bank account. I have received the money, it's my bank account, debit. Then I'll credit the owner, which have the capital account, you have to credit it, because it is a liability to me. It's an obligation. I have to work hard to pay the owner back the money. That is how, so that's the reason why capital accounts, capital, which is your own money that you are using to start business, always credited, have a credit balance, because you don't see it's not an asset. From the point of view of business entity, capital is an amount, it's like a loan from the natural person to the business to do work. And when the company see that I have taken a loan from somebody to work, I have to pay for it. So it's a liability in accounting. So one of the justification for business is drawings and capital having a credit balance. All these are justification for business entity considering that there's a legal separation between the owners and the business. Is that okay? Yes, please.
Yes, please.
Uh, so when you are explaining, look at it from that point of view. Now let's go to another concept. Going concern concept. This concept, I always tell students that even if you don't know anything, just take note of the word going. When you talk about something going, you can't tell me that at this level you don't know what going means. Now, going concern concept, talk about the fact that every company or every businessman does not have nobody open a business and say that this company I'm opening, it will collapse in 3 months' time. No, every businessman had the intention that you are establishing a company and the company can be there for the foreseeable time, like indefinitely. Every businessman, when you are starting company, you had the intention that the going concern assumption say that companies are expected to last very long time. What they have to, they will be there indefinitely. They have indefinite life, and therefore companies are going to go on going. They will be in operation for a very long time to settle all their obligations, and therefore the going concept assumption says that no businessman had the intention to liquidate or end the business soon. So the business will continue to be in existence into the foreseeable future without liquidating or curtailing business. So it means that the business is going to be in operation forever. And that is the absorption of every company, every business. No businessman has the intention to liquidate or wind up or end the business in the near term. Because of that, the general public, everybody, that's one principle and theory in business that every business, one is established, is going to be there forever and will not end soon. So because of that, going concern concept, people have trust in business and they're able to deal with business, it's because of the going concern. So when you see one of the justification for going concern is that people sell goods to companies on credit. So when you see creditors, or you see loans, bank loans and that thing, debentures in business or in accounting information, it is a justification for going concern because people have track that the business is going to be in operation for a very long time. Even if the owners of the business die, the business will continue to operate. Now, Guinness Ghana Limited is still in existence, but it was established in 1749 or 59, 1759. And look at that date up to now. The original founders of Guinness Ghana Limited, they are no more, but the business is still in operation. That is still because of the assumption of going concern because people are able to sell goods. They give raw materials to the company on credit. Banks are able to give loans to the company and say pay in 20 years time because they know that because of the going concern assumption, the business will continue to operate for indefinite time. So at any point in time, you can go to the business and collect their money. So because of the going concern, creditors don't have any doubt when they are selling goods to companies on credit. Because even if the owner dies, the business will not die because they are protected by going concern assumption. So that is it. So business have indefinite life unless otherwise something happens. But going concern or allow companies to enjoy credit facilities. It's because of the going concern assumption. That's why we have balance BDs and balance CD carried down in account. When we are preparing accounting, so let's find out why is the balance carried down. Why? Because we know that we are not going to close the business this year. So you have to know the balance we are going to take to the next year. So anytime you say balance carried down or balance CD, it means that you are certifying going concern, knowing that you are going to continue in the next year. And we are doing budgets. Like all these things certify that the business is going to continue forever. So trying to when you see creditors, trade creditors, when you see bank loans, when you see balance carried down, and this they are all justification for going concern, saying that the business is not going to end soon, and therefore people have that kind of trust in giving monies, in giving loans, selling goods on credit, and the rest to company without any fear. So that is that. So that is going concern. I hope that one too is okay.
Yes, please.
Okay. So that is going concern. Now let's look at if you have questions you can ask. But if there are no questions, then we move on.
Please, Doc.
Yeah.
So in a question, how much justification should we provide under each concept? How many?
Which one?
Justification?
Is that
Please, in a question, let's say a standard question, how many justifications should we provide under each concept?
oh one is enough.
All right, thank you.
One, so it's not there's no standard I have to provide 2 or 3. But I give a lot of justification so that at least you remember, but the question will not tell you to maybe give 3 or 4. Maybe talk about the concept and provide any justification in the financial statement that support this concept. You see, so that one you explain and talk about 1, it will be enough, or 2, depending on what you want. Is that okay?
Yes, please.
But I hope now you are remembering your accounting. It's coming, right? What we did for small, still small. What we did for good, so it's now opening small.
Yes.
So what could see account I could do for the be for the bank gusa. Obere wakai. Na da one. I feel say a bank account.
Yes, we are following more.
You have to follow because the only option there. But this one, I said, is normal like money. Now we have not done any calculation. Yeah, the projecting will start after when we start a double entry, where we start recording debit credit. That is where you see that now you are doing accounting. So we there just reading, remember. Yeah, just reading. Nothing difficult here. True or false? That is
True.
true. Uh-huh.
True.
Good. But these things that we are learning here too is going to inform our calculations. So they are important. You let's go. So the next concept is what we call money measurement concept. Money measurement. So read through. I'm giving you 1 minute. Just so I want you to get the whole thing, how you understand it. Then I'll also explain. So I'll call somebody about in a 60 second, I'll call somebody to explain to me what do you understand by what you read. So 1 minute. Yes. Who want to talk? Money measurement. What comes to mind? How do you understand it? So this concept that we are learning, please, as you go say, there are most about 14 points, but we not talk about all of them. We are just talking about the fundamental ones. There are others, but we cannot. As you go for when we are doing this, I'll teach you next year to is it the next semester? When I teach you 2 courses. So when I finish for this fundamental next semester, that is second semester. So yeah, first trimester, you're going to third time. I'll teach you taxation practice. That's if you do it second semester. But our the managers here will not do. Our the manager you not do taxation. It's accounting who will do the taxation practice. That's advanced accounting. So the managers here will not do that. Yes, the person who raised the hand should go ahead. Money measurement in a nutshell. What are you talking about? How do you understand it in your own way?
Okay, so please with the money measurement concept, what I can say about it is that, for example, when you are in a business and, for example, you purchase a motor vehicle, you are not supposed to just ride the motor vehicle, but you are supposed to add the amount that you bought that vehicle or any asset that you buy for the business. You have to state the amount in the recording of the transaction.
Okay. Okay, good. Is there any other person who wants to also add something to it? Money measurement.
Oh,
Yes.
please ask last week, ask the definition of accounting is that
Good.
whatever data that we collected should
That
be
is
expressed in terms of money.
that
So
is
that
perfect.
I think that is the concept.
That is the whole thing. That is perfect. So you see, I like the way you link this concept to the meaning of accounting. In fact, money measurement is actually the definition of accounting. Everything that should be measured should be in terms of money. So you see, as we define, and I like the way that as we talk about last week, it was about transaction and event that can be expressed in terms of money. You see, money is the common denominator. This concept is money in accounting, money is a common denominator of measuring economic activity. So if the transaction is so important, but we cannot get money or it cannot be measured, it cannot be reported in terms of money, don't record it. That is the whole thing. So the concept stipulates that accounting transaction and events should be measured and reported in monetary terms. So if I might call it transactions or events, it's anything that happens in organizations that is an event. Transactions And by some of the events and the transactions, some can be, we can assign money to them. We can ask. So somebody is like, employee is dead. That's an event that has happened in our organization. But when we are preparing financial statement, we cannot measure that debt in terms of money. That if employee dies, it's 200 or 100. There's no standard measurement of debt. So though it's an event that has happened, we will not see it in accounting information that death of a member 200. No. But if maybe when the employee dies and say transport to the funeral of an employee, maybe hometown, transport, that one is something that we know that our transport for here to them, there's a standard rate that TNT fuel is this. We bought 10 gallons of fuel. That one we can quantify. 1 gallon is this, and we bought 10. Then we multiply and say 3,000 fuel. That one is quantified. It's monetary. We can assign money to. So that's a we can record the fuel. 1,000 gallons. That's what we bought for the fuel. But the debt is an event we can. This is what we mean by money measurement. We measure so all transactions and events that are reported that you can see in our financial statement, accounting data, is those that can be expressed in terms of money. That is money measurement. So if the transaction or that event is so important, but we cannot assign monetary value to it, no matter how important that information is, you cannot record it. That is the disadvantage in or with this concept. So that all information should be communicated in terms of money. So last I gave an example that if the managing director is supposed to go and meet a certain board for an important contract, if the managing director is able to attend, the company is going to get the contract and it will bring about 20 billion profit. But the day of the meeting, the company management, the person who matter was sick and couldn't even go for the meeting, and the company lost that contract, and therefore eventually they felt that they have lost 20 million profit. But the event that happened that led to the loss is the sickness of the managing director, which has led to EAC. But you cannot say that you are going to put value on that. So money measurement concept talk about further in accounting. Money, all transactions are measured in terms of what? Money. Money is a common denominator. And the justification is that all the information you see in accounting, financial assets, liability, debtors, creditors, anything that you there's a value to it, there's a money value to money which assigns it. You don't see any item that recorded in a financial statement and will not be measured in terms of money. No. Once we write purchases, stock, motor vehicle, building, everything, there should be value to that amount. It means that they are items that can be measured in terms of money. That does not mean that that is the only information or event that happened within the year. I take January to December. There can be a lot of transactions and other effects, other things that happen within the organization, but some of them we cannot quantify them in terms of money. So you will not see them in the financial statement, but only those that can be quantified in terms of money. Periodicity concept is another concept. Period. When I talk of periodicity, I talk about period, it's a break. Now you see, this concept comes from the point of view that because the going concern assumption states that the business is going to live for the indefinite life, because going concern assumption makes business have indefinite life, that we don't know when the business will collapse. So because of business entity going concern, before a going concern assumption, which says that the business is going to operate for indefinite time. Nobody knows when the business will die. No, so that is going concern. Because of that, that's why we have periodicity. Because now business and companies too, people have invested money into the company. People buy shares. People invest money in the companies and that thing. And they also want return. Any investor want in returns on their investment at a point in time. So If I buy shares or invest in the company, buy bonds, debentures, and until the business die, you cannot get any returns. Because I think a business, when we end the business, that's why we can now share and give you my profit. But because the business also have indefinite lifespan, because nobody know, and we can also investor can also stay till when the business will collapse before they get something, then that comes where we have the periodicity. Then this person will say, that, okay, because of the indefinite life of the company, because of the going concern assumption, and because investors also invested money in the company and they want return, then the life of the business should be broken down into periods. Sometimes 6 months or 1 year. Usually the common one is 1 year. Then after every 12 months of a business, let the management pause the business, calculate, determine the profit and expenses, the income and expense that you have generated within 1 year, 12 months, declare profit, and now continue. And so that profit, now shareholders can get dividends and that. Then you continue. After 1 year, pause, check your activity, declare whether you are getting profit or not. Then you call that is what you call periodic. So it's because of the periodicity concept. That's why the life of a business are always broken down into time period. Sometimes 6 months or usually 1 year, every 12 months, the financial year. We pause and we calculate, we look at our revenue, again our expense, declare profit, then we continue another 12 months periodicity so that investors can also get return on their investment. We cannot wait to when the business die or collapse before we get return. If you do that, you the human being will die, your spirit will die, your everything, you will die. Still the business will continue moving. You don't get anything. So for you to get something, let's break the lives of business into time periods like 12 months. Every 12 months we pause, we determine profit, we share, we will continue in that order. That is what we call periodicity concept. So the justification is that financial year is 12 months. Sometimes accounting period can be 6 months. Some year if it's 6 months or even 4 months, depending on what the business or the shareholders will do. But the standard is 12 months. Every 12 months, business pause, they prepare profit and loss accounts are prepared at the end 31st December of every month. If you start from 1st January. So it's mandatory. It's required by law. The company could have made it mandatory at the end of every 12 months, all business to prepare the account, declare your profit and also your assets and liability, publish it, and it's law. So every 12 months, companies prepare accounts and disclose it for public to know, which is because of periodicity concept, historical cost concept. Always it's okay. Periodicity is okay.
Yes, sir.
Yes, please.
So now when you stand somewhere, you are talking about accounting, talk like you know accounting. Don't fear anything. So you cannot teach. Some of you, I know you are teaching, or you are not teaching.
We are, sir.
You are teaching accounting, or you are now going to teach accounting.
Now I'm going to teach you.
Okay, so it means that so that you are going to teach at SHS, right?
Yes, please.
Good, and that is why what I'm doing is very, very important for you. See, you have to understand, and the danger is that for students, if you don't prepare yourself well, go and start, some of them can disgrace you. You know that. So you have to understand some of this. Yes, you have to understand some of these things very well. You have to understand so that when you are a teacher, ask madam, why or say why is it then you say that oh okay, this is reason because then you will say oh okay, that's great. But I feel like if you start a question and then go and find a homework and this one, why worrying them. And this case we have this time because of the access to internet, they may find something. We find out, but we read about this thing, and you are what is different from what you were saying. So why, then, madam, or a problem? So please try to understand everything very well, so that when you stand in front of students you are teaching, you can express yourself very well and give them the correct information. Historical cost concept. This concept just says that assets and liabilities should be reported at their original cost. Historical original cost that was incurred in acquiring that particular assets or in incurring that cost. That's all. Historical. When you talk about historical, you're talking about past, something that has passed. Historical costs. Assets and liabilities are recorded at their past cost or the original cost or the historical cost at which those assets were acquired or incurred. That is it. So what it means is that because business are going to be in continuous operation from year to year. So I bought this motor vehicle or motor car, a Toyota Camry, this year. It is 10,000 Ghana cedis. That is, we bought it as a company. So we have recorded 2025 Camry, 10,000. So we have receipt. We have document to it. It's there. So in our assets, in our balance sheet, once you stay there, we have Toyota Camry. You have to, because of the money measurement, you have to stay the amount 10,000. This year is okay, it's there. But when you go to the next year, 2026, maybe the Toyota Camry value is no more 10,000. Maybe it's 12,000 this time or 15,000. When you go to 2027, the asset as you are going, because the time value of money, the asset you're building and everything, which when you started the value was 2,000. Now that we should do revaluation, the company building is now about 10,000, but and it's 2,000 in the boost. The historical cost consists that let it be like that. All assets should be recorded as their original cost as how you got it. But don't worry yourself with the current market value of your asset. But if you do that, you are going to create problem for accountants. What it means is that because accounting deal with evidence and objectivity, that is better. So when auditors come, this asset is here, it is what we bought it. Where is the receipt? Only the receipt. The receipt will correspond to the value because we bought it in 2005. We bought this building 100,000. This is the receipt. Okay, 2005, 100,000. As at that time, that was the value. So there's that. Now we are in 2026 or whatever, 2025, 20 years later or 10 years later. The asset you have not sold it. That same building is in the business. Let the value still when you record that building is still at 2,000. Let the 2,000 be there. There's nothing because the receipt is there that in 2025 bought it 2,000. You are now in 2020 in 2005 bought it 2,000 and the receipt is there. Now you are in 2025. Don't worry yourself to change the value to current value. It's still required 2,000. There's nothing wrong. So the receipt can be verified and show the that is it. That's accounting. But if you want to sell the building now, then we can do revaluation to bring the price to the current value. But in accounting, all assets, so once you have bought the asset, the original cost should always be recorded in the books, and that's what we call historical. And one advantage of this principle is that it saves accountants time. But if not, look at company, a multinational company that has a lot of assets and liabilities. If we have to, it not be the historical cost concept. When we are coming to prepare account, the accountant should have to go to the market, find the market value, original value of all the assets, and look at the number of assets that company will be having. And you are now going to look for cost, how much is it, and there will be variation because somebody will say that I went to this shop, it was 3,000. The same as another person somewhere can say it is 2,000, and it will bring this organization in accounting. So to solve everything is historical. Once you get one cost for the asset, keep it throughout the books so that we can compare, so that we can verify. This is historical cost. And this is the reason why always you can see that an asset in the accounting will be lower. See, motor vehicle, Toyota, or maybe 4x4, the value will be small, or building a small value. It doesn't mean it's because of what? The historical cost concept. All assets should be recorded at the historical cost of acquiring it, so as to save the accountant time for going to market to look for current market value of their assets. Now we have revenue recognition or realization or accrual concept. Now, these are two concepts that have been merged, but we talk about it one after the other. That is the first one, revenue recognition or realization. Accrual, I'll talk about accrual, is also another concept on its own. Now, when we talk about revenue or sales or revenue recognition or realization, this principle says that revenues and expenses are recognized. In accountancy, recognized. They are recorded or they should be recorded. Revenues are recognized or recorded in the books or in accounting when the revenue is earned or when the revenue or when the sales is made, but not when money is what received from the customer or as money is paid for the expenses. What we are saying is that anytime in business, when you are doing business, when you sell goods or when the revenue is earned, even though you have not received money, you can record it. That when you are doing your accounts, you can record. So you have made sales for the whole year. There's cash sales and credit sales. In accounting, because this concept, you don't record only the sales that you have made, you have received money for. But when the total sales will include cash sales and the credit sales, because the customer has taken the goods to the house and used it. So you know that while the goods have been, the sales have been made, even though the money has not yet been paid, still you can account for, you can add it to your things as if you have received the money. So when you are talking about total sales, for you to know your profit at the end of the year, those that you have not even received money for, but the goods have been taken, you can still recognize it. So revenues or sales are recognized as and when goods or services are provided to the customer and the customer accepts that a liability has been incurred for the goods received or services rendered. This concept also says that revenue is recognized as earned and costs or expenses are recognized as incurred as and when the transaction occur and not when money. So that is where you need to take note. So revenues and expenses are recognized or they are recorded in accounting as soon as the revenue is earned or the expenses is incurred, but not when money is what received for the revenue or when money is what paid in that that kind of for that expenses. What it means is that when you are listing your expenses, maybe you have used electricity or water. You are filling using for the whole year. You have not paid. That doesn't mean that you have not incurred. So when you are listing your expenses, you just list only expenses that you have paid for, but the expenses that you have incurred but you have not yet paid, you don't. No, you don't do that. So recognize that once the expense, you know that you have incurred it, and that will the revenue you have earned it, you are going to receive it. Record all of them. That is what we do in accounting. So in accounting, the justification is that credit sales and cash sales are all recorded. How we are paying expenses that we have paid for, and always expenses. So you see, arrests. Once you have arrests for expenses, they are all recorded in accounting. Oh, maybe you have paid expenses, pay seven. There's the always or arrest, outstanding expenses. They are all recorded because even though money has not yet received, recognition concept allow you to what recorded. That is what you call money. No recognition concept. We realize or realization concept. Money's or income or revenue and expenses are recorded in the books as soon as the income is earned or as soon as the expenses is incurred, but not when money is received for that revenue or when money is paid for that expenses. So that is it. So always once it is incurred or earned, you record it. Don't wait for when the money is received or money is paid. That is the realization concept. Then another aspect is also the accrual. You see, accrual concept is different from matching because some people So accrual or matching. Matching is different from accrual. You see, when we are talking about matching concept, matching is another concept called matching concept. This one. Now you can see my drawings, what I'm doing. Matching concept. You can see.
Yes, we can see.
Okay.
Yes, please.
Now, matching concept talk I found that for a company or for a business to be able to determine whether you are getting profit or loss at the end of a period, all the revenue that were generated should be matched against the expenses that were incurred in generating that revenue. That's what we call matching. Matching means place side by side. So this matching is not your cease match kind of. You are talking about that match them against it. That means from January to December, if you want to know that you are getting profit or loss for your activity, try to determine all the revenue. That's what you call all revenue that were earned. That's list them and place side by side. That's the match. So the matching concept is just talking about something like this. You have T account, like revenue is one side here, expenses is also one side. We match them. So revenue one, expenses this is how much we incurred in getting this revenue. Oh, we have gotten revenue of 3,000. What was the cost? Oh, we spent so much on this thing before we got it. So you see that every revenue that you incur, there's associated cost that you incurred. Or every revenue that you earn, there's something that you did, or what we call associated cost that you incur before earning that revenue. So match all the revenue should be matched or placed side by side with their corresponding expenses. Now, at the end of the day, you subtract the expenses from the revenue. If there's something like that's what we call, we say, profit. But if the revenue is less than the expense, then it's loss. That is the matching aspect. The matching concepts assess that revenues recognized should be matched with expenses incurred as a result of earning such revenue in accounting period. That is the matching. By doing the matching, you need to also take into consideration accrual concept. So accrual concept also says when you are doing accrual concept says that when you are doing the matching, you are placing the expenses against the take into consideration that there are some expenses which have been incurred this year, but it's for next year. There are some income that have been received this year, but it's for next year. Take away those things. That's what we call accrual expenses. So there are expenses that have been received or that have been earned this year, but not all of them relate to this particular year. So, for example, you see rent paid. The rent for every year is 100 cedis, but this year you have paid 400 Ghana cedis. So, if you are doing the matching, in your books, you see rent 400 Ghana cedis paid, but you are doing profit and loss for 1 year. You cannot charge all the rent 400 to this particular. When you do that, you are not being fair to this particular year. You have to now bring in a accrual concept and say that, okay, if every year is 1 year, you have paid 4 years as rent, then only 100 cedis is for this particular. The remaining 300 is prepayment. You subtract it from what you have paid to get the actual amount of expenses that need to be chargeable to this particular year under consideration. And that is, once you do that, we say you are applying accrual concept. You are trying to isolate expenses that do not belong to this particular year from the expenses. You are trying to subtract revenue that have been received this year, but they don't belong to this year. You are a tenant or you are a landlord. Every year, the rent is 1,000 Ghana cedis. Somebody has paid 3,000 to you. You have received all the money this year, 3,000 Ghana cedis rent income, but you know that is for 3 years, and you are preparing account for 1 year. How can you charge all the 3-year rent received to this year? No, you have to say that, okay, even though I received 3,000 in my accounts, only 1,000 belong to this year. So when you're preparing this year account, subtract the remaining 2,000 from the 3,000 and deal with and that is what we call the accrual. So accrual concept is taking into consideration arrears or amount that have been received that do not belong to, subtracting and adding that. That's what we call your doing accrual. but the matching is expenses placed side by side with revenue. You have questions you can ask. Let's move on. You can do a lot of video on it. So that's content concepts and concept on conventions and other concept is objectivity. Accounting we deal with objective items. We don't deal with subjectivity in accounting. That's why if the thing we cannot quantify in monetary term, we don't record. Financial information must be presented and reported without subjectivity. I know why. The reason is that I told you sometimes that accounting, the information you are putting out there, somebody can die. Because if you are not objective as an accountant and you bring subjectivity, people can die. Because people are going to buy shares in your company. People are going to put their investment. They're going to buy debenture, huge money to the company based on what they see that you have presented. So you are saying now we pay dividend every year. I'm going to pay dividend of 100 Ghana cedis per share. Then people go and withdraw their life savings. But meanwhile, as a subject, it's not true. So one of the principles in accounting is objectivity, and that's why in accounting we do figures. What I do in figures, it is figures. You don't have to think that I think or I believe it could be the no. It is this definite accounting. So financial information must be presented and reported without subjectivity. This is the information. That is the information must be free from bias and must not favor one interested party at the expense of another interested party. That different accountants can attest to the accuracy of the information. So when you are presenting information, objectivity principles say that the accounting information should be presented as it is to what we call the true fair view of the organization. That is prepared information. If you have assets 2, record the 2 and their value. If the liabilities are 10, record the liabilities are 10 and have 2 assets. Let the public know that this is the financial status of the organization. Don't go and say, hey, if people see that we have only 2 assets and our 10 liabilities, they will distinct themselves from the company. So because of that, let's say that we have 15 assets and maybe 5 liabilities. So you understand the figure that you give. Meanwhile, it's just on paper, but in reality, those assets are not there. Once you do that, you are going to create a problem, and that information is not objective, it's subjective, and it is false. Once you do a false information, you have accounting information, you are killing people. People can lose their investment, and that's bad. So that is one cardinal principle. Accountants, you have to be very objective. Then you have consistency concept. Today, we are learning all the concepts. And these concepts, as accounting, so when we mention it, you don't need to even go and open book. Once you hear the concept, you should be something. Every time I mention a concept, there should be something that should come to your mind as an accounting student. Consistency. Look at the name. Consistent. This person says that where there are alternatives for the treatment of a particular financial transaction, the method selected should be used in the treatment of such or similar item from period to period. Now, consistency concepts say that once there are lots of principles and treatment or methods that can be used for treatment of transaction, but once one method is adapted, accountants are advised or business are advised to keep to that method for a period of time before changing it. Now, note that consistency does not mean that normal students always make such mistake. Consistency does not mean that once a method is selected, it cannot be changed. No, that's not what consistency is talking about. They are saying that you have to be consistent. Why consistency doesn't want that this year you use straight line method of calculating depreciation? Fine, no problem. Next year, then you're going to use reducing balance method of calculating depreciation without giving any rationale. Then the following year, you're going to use sum of yard again. Every year you change different method for treatment of the same item. No. when you do that, it will make comparativity very difficult. Or accounting, we have various formats. We have the vertical format, we have horizontal format in preparing the income statement. So we have one that you can use T accounts. We have other ones you don't use T. Then when you decide that we want to use the vertical format, sales is here. Then you put the figure. Less cost of sales, that. Then purchases, everything, do that. Up to for some years, maintain. Because customers or the shareholders or users of financial information always make what we call comparison. Comparison. So if you are not consistent with the use of the method, it normally worries users who are not well informed to be able to make comparison with your financial statement. Now, let's assume that you use the vertical. So this year you are preparing an account, use the format that have the sales here. So sales, then purchases, all the items they are, you didn't rule lines, sales, purchases, they are all there. Fine. The next year, we are consistently expect that use that same format where you have another sales here, then purchases here. The third year, use the same so that the customers or users, even if they don't have any accounting knowledge, they pick last 3 years statement. The sales, they can see that, oh, this is the sale. The following year, the sales, the sales, the third year, then they can compare, okay, the sales have been increasing. They take the next item, purchases. They can see that they cannot make comparison because in the same format. So the figures, they can see the figures and now try to see whether they are increasing or not. But this year, you use this format where you have the sales here. Then the following year, instead of you to use this, then you go and change the format and use the T1, where you have sales at the right hand here and the purchases go to here. Now, when they take the last year, the sales there was no lines you rule. But this year, you are they use the T1. Now they become confused because it's different things altogether. So consistency doesn't mean that you can change it. You can change the method. But when you are changing, give reasons. Rational. Oh, from this year, we are changing from using this one to T account because meaning that then you give rational explanation so that from there you keep using the T. You don't have to be changing the methods over time. When you do that, it will cause problem for users of the financial statement. So consistency is very, very important. You see that once a method is selected, accountants are expected to use it for a period of time before you can change it. Consistency. One of the necessary ingredients for consistency is comparability. So consistency is needed for comparability. So one of the necessary ingredients for consistency is what we call comparability. Because if you are not consistent with the preparation of the financial data, users cannot compare your financial statement. And don't forget that there are two types of comparison that users of financial information make. There are two types of comparison. These are not in the slides, but you are here, so you listen. We are what we call users make two types of comparison with financial statement. Every company, the users or the share. So we have one we call intra. One is intra. I don't know whether you can see it. Intra. This one, intra group comparison. So intra group comparison. Then we have inter group comparison. So you can write them down. I will explain that. So when you talk of consistency, one of the necessary ingredients for consistency or reason for consistency is comparability. Comparison. So users make two comparisons with financial statement. One is intra-group comparison and inter-group comparison. Sometimes people call it inter-firm comparison and intra-firm comparison. Now, when you talk of intra-group or intra-firm comparison, this is where the users or the shareholders or employees, or when you talk of users of finance, now it's not only the shareholder, shareholders, employees, investors, customers, government, they are all users. So intra-group comparison is where the users of financial information compare the performance of their company from period to period using the same company's financial information. So let's assume that MTN as an organization are their shareholders or their users. Now the shareholders of MTN, when they take MTN financial statement for the past 3 years, so last 3 years, then the last but one, then the current year, 3 years, and compare the performance of MTN from year to year based on the MTN's own financial statement for the past 3 years. Oh, last 3 years, the sales was this. Then there's 2 years ago, it was this. Then this year, then they do that kind of comparison. Oh, okay. It's like every year the profit has been increasing. Oh, it's like every year MTN open a new branch. Every year MTN, then that is what we call intra-firm within the same firm. Intra means within the same firm, using the same company's financial statement, doing the comparison. When you talk of inter-firm, that's between firms or among firm comparison. This is where the shareholders of one company take their financial statement and compare it with another company in the same industry to see whether their company is doing well. That comparison is what we call inter-firm or inter-group comparison. So, for example, MTN company, the shareholders of MTN, when they take MTN financial statement and now compare it with, let's say, Vodafone or Airtel Tigo, that's comparing the same industry but different. Now they'll be able to know whether their company is doing well or not, and that's kind of comparison that people do. So, interfirm or intrafirm, these are comparison that we do. Then we have another. So this just an extension of the principle. Then we have another principle, which is full disclosure, and that is what we call note to accounts. It's required by law that sometimes when you prepare accounts, you have to disclose. That's what we call note to account that explains some of the items. So in the preparation of financial statement, any information that is significant and material should be and could affect the decision of the user of the on the basis of financial statement must be fully well disclosed or included. So you see how we prepare any financial statement, it's what we call note to the account. And the note explains some of the things that the users may not be able to understand. So you have to disclose it. So after you have prepared the accounts, as in the note, you write note. Maybe the base of our account depreciation was calculated based on straight line method. It's a disclosure. We have disclosed the base for calculating depreciation. Oh, the interest was 10% this one per annum. Or this, so you provide certain information that the users or assist the users in understanding some of the information that you have put in your financial statement. Materiality concept. Materiality. This concept, when we are talking about it, you have to be very careful because they talk about significant. When you say something is material, they are talking about very significant, important of that. In accountants say, oh, this is very material or it's immaterial. Material means something is important, significant. So information is material if omitting it or misstating it could influence the decision of the primary user or users of the financial report. So we say that an information is material is important if we don't include it in the statement or if we understate it or overstate it, that thing can affect the decision that the user will make. In that case, you say the material or the information is what? Material. So if we don't include it and it does not affect, it will not significantly affect the decision that people will make, then that information is what? Immaterial. That is how we see. So materiality have to be understood from that point. Now, one thing is that an item will be material to a certain company, but that same item will be immaterial to another company. That's one thing that you have to always do. So when you're talking about materiality, yes, you are talking about item being of value, substance, but an item, when you talk about materiality, you have to bring the nature of the business or the size of the item, the business in question. Because an item can be material to one company, but that same item will not be material to another company. For example, when you take University of Cape Coast as organization, University of Cape Coast have so many assets, a multinational company or business or enterprise. A number of assets. Look at the buildings that UCC is having, go from campus and other regions, and look at the vehicles that University of Cape Coast is having. Look at but there are certain things that like furniture, even vehicle. The cost of furniture for University of Cape Coast will not be treated as non-current asset. It will not be part of their fixed asset. No. When UCC is preparing financial and listing assets that they have, the cost of furniture will be treated as revenue. They will see as expenses, expenditure item. They will not. UCC will not list in their part of their non-current asset or fixed asset furniture. No, because it is immaterial. When you look at the nature of the organization, furniture is not an asset to them. They will treat the cost of furniture as an expense when they have bigger things. So it's immaterial. But take a 1 month ownership, let's say supermarket or a small business. The furniture is the number one asset. Furniture is an asset, bigger one. So you see here, the furniture can be material to a certain company depending on the nature and the size of the company. But that same furniture is immaterial to another organization. So when we are talking about materiality, the nature of the organization has to always come to play to determine whether an item will be material or immaterial. But the point is, an item is material if we don't include it, it can affect the decision that somebody will make. Duality or dual aspect of accounting. This principle says that every transaction in accounting has two aspects, and this is where this is why you need it for double entry. Every transaction, when you buy item, when you are paying for something, when you receive money, when you are selling things, anything transaction that involve money in accounting has two aspects, which are equal and opposite. That is the giving aspect and the receiving aspect, which must be identified, measured, and recorded as debit and credit side of the transaction. In business or in accounting, any transaction, there are two aspects. So when you are buying something, there are two aspects. You give out money, you receive something. That's the duality. When someone is paying you money, that you give you the money, you give services. Either you render service before you give them. So anything that involves money or transaction, there are two aspects of that item. Either you give out something and you collect something, or whether that is it. And that's what we call debit and credit. So for every transaction, it must be recorded twice. You need to record the debit aspect of it, and you have to also have the credit aspect of it. So this one will be leading us into the thing that we are going to do the calculation. So now the last one, are we counting the principles so far? How many have we talked about? That why you are not doing that? Are you there? My people, are you there?
Yes, sir. Yes, sir. We are there.
So far, how
Yes,
many
sir.
are you right? Are you counting them? Or you are just listening? Me, I'm not
We
counting.
are
Me, I'm just.
we are followers.
So how many? How many have you? Have you got to about 10?
Yeah, 12
We are,
now.
we are
12.
we are 11. We are now on
No,
the
12.
12th.
12.
We are now on the
Yeah.
12th.
Wow.
Yeah.
So we are going 12. Good. But I want to believe that all the concepts that we are talking about, at least you are getting the uniqueness of each of them, right? You are getting the concepts, right? The principles.
Small.
We
I don't want that's small cry. Small way. How can you say small?
we are getting it with the examples that you are adding to it.
The examples are helping, right?
Quality.
Yes.
Ah,
Yeah. But
small. Ah, how can you say? Can you measure small? How do you measure the small?
Okay, sir,
It's small.
70%.
Wow. That's small. Okay, but at least you get it. See, sometimes when we teach like this in the classroom, but when you go and you sit down and read over, and it will come. The understanding will come. Okay. Now this is the last one I want to talk about. So 12 is enough. There are 14 principles. I think we are talking about. In accounting, all the principles are 14. So I think 12 is okay. So the remaining two, when you grow, then go. You can look out for it yourself. I'll talk about it. Now, please give me just a minute. Let me. Okay. This is the last one. Just a minute. Read through. When I come, I'll call somebody. Yes, wait. I'm coming. Prudence concept or conservatism. Now, this prudence concept, when we talk of the word prudence, it means what? Wise, being wise. Prudence, reading Bible is there. When you read Bible, my son, when you read normally one kind of some Proverbs on the hand, read the prudence, wise, conservatism. So this prudence concept is talking about the fact that accountants should be very wise when preparing the financial statement. We have to conservatism, prudence, wise. This principle requires that gains or profits are not recognized or accounted for, but also should be anticipated. That is not what to say, but they are trying to say as accountant, don't anticipate too much profit and gains because transactions and events can change within a year. However, as a accountant, when you're prepared, don't be so optimistic about the item that we will get this, we will do this. You have to be a bit pessimistic. Try to be conservative so that you make anticipation or anticipate, make provision for losses more than gain. So it is because of this principle that's why we have provision for bad debt. When you see provision for depreciation, provision for bad debt, it means that people are owing us. If you have the principle saying that as accountant, when you are preparing the account, try to be very wise. If 10 people are owing the business and you are going to prepare account, don't just assume that all the 10 people will pay. Just say, let's assume that 3 people will not pay. Something can happen. So prepare your account based on the 7 people that for debtors we are making a provision of 5% that they will not pay. So what we are expecting is what 7, maybe, and then 5% or 90% to pay. You use that one. So in case everybody pay, it becomes like a gain to a company. That's better that way than to say that everybody will pay. When somebody unfortunately get accident or somebody something liquidate and the person did not pay, and that one become a bad. So you see, even though we are prepared conservatism or prudence concerns, accounting should expect or anticipate for more losses rather than gain, so as to help you prepare. Now let me give you this scenario. So I'm giving a scenario. When I finish, I will ask you to. There was a company A. So listen to that. Company A. Okay, let me say company A and company B. They were going to do AGM, annual general meeting. So company A accountant came and present. So at the AGM, annual general meeting, you have to read the financial statement. So he came and started. Oh, looking at the air blowing around us, the future is what? Bright. And they started clapping. Oh, that shareholder, the whole hall. So we are anticipating that the profit or the sales will be so much. Messages we are targeting it, our customer base will increase. We can kind of focus here. So I don't know the year we are expecting a profit of 20 billion Ghana cedis. 20 billion Ghana cedis profit. Then the shareholders they started clapping for him. At this accountant, they are happy because all the shareholders going home very happy. Yeah, the accountant said they are going to get 20 billion profit, and this one the shareholders are saying, oh, so dividend per share can be increased by maybe 200%. So this time we are if things go this way, we are going to get dividend per share. Maybe we are going to pay 150% per share. So the shareholders are very happy, and they see this accountant as high in esteem. Oh, this accountant is good. When they went, shareholders started doing things. Those who go for loan, those who buy item because they know that this year they are going to get paid. Now the company B, accountants came, they got their AGM, and this accountant for company B just told the employees that okay, the shareholders that in fact we are not certain, things can change, and some transactions can change that. So we also talk about we are expecting sales to be this and this. We talk about it, but because of uncertainty of this thing, the transactions sometimes we are not certain about certain things. But let's hope that things can be. So if we are careful and things go as well, we are going to get let's say a profit of let's say 5 billion Ghana cedis, because this company or this accountant didn't want to raise the hopes of the shareholders high, even though things can change, but he was so careful not to overstate and so pessimistic. Now, the shareholders they were just reluctant, but why okay, they clap small for him because then we are not once you are not getting loss or you are getting profit, they will take it like that and they all left. And the year began. Then inflation started going up, fuel prices, then COVID came, then Ukraine, Russia, Ukraine war, then COVID, a whole lot of things, then things started changing. The event. So at the end of the year, they all came back. And now at the AGM, this accountant, the accountant company, accountant, I feel okay, things didn't go as we expected, and because of this, we got we didn't even get we were able to get break even. And the company B, the guy who said they get 5 because of the provision that he made and the thing, he came and now reported a profit of 10 billion rather. Now, between the two accountants, who do you say was what? Wise?
The B. Accountant B.
Accountant B.
Why? Yes, go ahead. Why B?
Because what he proposed was less, but at the end of the financial year, gained more in the profit.
So you see, he was able to understate. He was able to say that, oh, if it sells, maybe because the things will not go well, maybe people may not patronize our product. So let me understand. If it's those who are owing that, just divide by 2, then we get half of it. But in actual fact, when we started, things started going well. Everybody paid. And then all the thing that you reduce it, you get it in full. People will see you are very efficient. You are very efficient than the person who said they are going to. So that is what prudence concept is. As accountant, don't just anticipate, don't make provision for more gains, but rather make provision for losses. So that if the loss did not happen, then they won't tend to gain, and that will make you more efficient. So that is that. So, ladies and gentlemen, let's bring us to the end of this set, conceptual framework. Now we have gone through a number of issues. Actually, we are looking at the financial users of financial information this morning. We have also looked at what the accounting concept. So, if you have questions or comments concerning these things, the floor is open. If not, we move on to another section. Now, question, comment, yes, any contribution or anything? Who raised that? You can go ahead.
Please, Doc.
Yes.
Please about the duality concept.
Dual aspect, yeah, duality.
Yes, please. Sometimes when questions are given to students relating double entry, it can be stated in this way: started business 10,000, 6,000 at bank, and 4,000 cash in hand.
Yeah.
So it will affect capital and bank and cash. But sometimes when you split the cash and bank into 2 separate distance, they find it difficult to get it, whether it is duality or
yeah. You come to that as like that's where we are going and double entry. So let's assume that somebody, you see, when we talk about duality, it has what? Every time has 2 what? Aspects, dual aspect, and it is equal and what? Opposite. Equal and what? Opposite. I don't remember that one. The duality aspect, so that every transaction has 2 aspects. That's debit and credit, and it is what? Equal and opposite. So let's see, started business. Even though we have not gotten, let's say started business with what? Why did you say
1,000 Ghana cedis?
1,000 Ghana cedis. So started business 1,000 Ghana cedis. And you said paying some to paying what? You get a different.
6,000 at bank and 4,000.
Okay, so 6,000 at bank
and 4,000 cash.
4,000 cash. Okay, so this is bank and this is cash. So the owner is starting. So this is capital. The initial amount owner used to start business is always called capital. So this is it. So the owner is starting business capital 10,000, or let's say 1,000. Okay, then this cannot be 6,000. Then I have to make it 10,000 if I make it higher. So the owner is starting business 10,000 cash, but the 10,000 he paid 6,000 to the business bank account, and there's 4,000 in hand. And we are saying that every transaction also is dual, 2 assets. So now you have to open the capital accounts. So we are going to double entry so very soon, but because of this, let me clarify this. So this capital accounts, then you have to open cash. You have to open cash accounts. So this. How you see the drawings I'm doing?
No, please, that doesn't appear.
Oh,
No,
No,
sir,
please.
I'm not sharing. Let me do this. Wait. I thought I was sharing it. Okay. Oh, okay. Let me. Okay. Let me use this. So I hope now you can see the screen.
Yes, please.
Yeah.
So why we say that the owner started business says 10,000, right? So let's say 10,000. So now the one I write, you see.
Yes, please.
I want to do the demonstration for you to see. Okay. So
Yeah.
the dual aspect, the person started business with 10,000. So let me say that this is 10,000. By this 10,000, you said he pay 6,000 at bank. Yes, go ahead. Then 4,000 cash in hand. So this is the whole thing. So this is what we call capital. This one, the 10,000 here is capital. That's the initial amount. This one, capital. How this how your question was, right?
Yes, please.
The person started business with 10,000 capital, paying 6,000 to the bank and 4,000 cash in hand. So now this is what you do. It's still dual aspect, but this is how it happened. Now you open capital accounts. So let's say this is the capital account. So let me make it capped because writing this one is difficult. So capital accounts, you open it. Then you open bank accounts. So let me use BA for bank accounts. There's a bank accounts. Then you open cash. Cash accounts. So now let's do the dual aspect here. Now the dual aspect is that you said the duality of every transaction has two things. Dual aspect, there is dual aspect which is equal and opposite. Remember that. So when you come here, because he paid 6,000 into bank, you debit the receipt. The bank is receiving 6,000. So you go to the bank account. So this is the bank account. So debits are here in the name of capital. So here is receiving from capital. So you write capital here. The money is coming from capital. How much? 6,000, right? So the debit bank 6,000. Then he pay 4,000 also into cash accounts or it's cash accounts, cash in hand. So that here when you come here, so capital. Here, capital is here. 4,000. 4,000 here. But when you come to capital accounts, because of business entity, we said that always capital will have a credit balance because it is given to the business. So here you come here, capital accounts will say, okay, I have paid 6,000 to bank, so 6,000 here. Then cash accounts to I have paid how much? 4,000 into what? Bank accounts, 4,000. So what you see here is that the capital account have been credited with how much? 10,000. And bank accounts have been debited with 4,000. And so the dual aspect, which is equal and opposite, is that there is a credit balance of what? 10,000. And there is a debit of what? 10,000. It doesn't matter whether it's in 4 accounts or, but the total debit should also sum up what? 10,000. So when we do trial balance, the debit side will be debited 10,000 and the credit side will be credited 10,000. That is the equal. That means you are giving out 10,000 and you are receiving 10,000. That is a dual aspect what we are talking about. It does not mean that you are going to record only 2 things. No. But the total debit for that transaction and it should be equal to the total debit, but there will be a corresponding opposite side. Do you get it?
Yes, please.
Are you sure?
Yes, please.
So the duality of transaction, dual, that means there is an equal and opposite side of the transaction. So if you spend 1,000, which your books are going to be credited with $1,000, we have to get a corresponding debit side, which is also be 1,000. So if that 1,000 that you are paying, it went to 4 accounts, the 4 accounts that you are going to record it, then they should, when we sum the debits in that 4 accounts, it should be equal to what? The 1,000 or the amount the credit. So when you are preparing the trial balance, because the trial balance is a memory, we see the debit and credit, so the total debit should be equal to the total credit. That is what we call. But you cannot have a situation whereby you pay out 10,000 and the debit is, let's say, 8,000. That one is not possible. When we do that, then there's something wrong. And that's where we are going now. Double entry principle. Yes, ask your question.
Okay, please. My question is about users of accounting information.
Okay.
And potential investors who are yet to purchase shares and invest in their money in business. What are some of the companies that we can buy shares?
Oh, okay. So far, at last, the commercial bank, they sell shares. They were selling 60%, they float shares. But you see, there's a time that they float the shares. So sometimes they make it public. About 2 years ago or last year, but you can work with commercial banks, say you want to buy shares, their share, they will give you a prospect. There's a form you will fill, they will give you share price. A share is just a certificate, a paper that will be given to you. But once you have that certificate, you are part owner of that company. So you can go to commercial bank. I think last year they were selling 60% per share. 60%, there's a minimum that you have to buy. So if 60% per share, you can say unless you buy 5,000 shares, maybe you can be a member. So initial. So you can buy maybe. I am in a class. I'm teaching. So call me after 12. Yes. Please, are you there? Are you following me? Can you hear me?
Yes, please.
Yes, please.
So the shares, if you want to buy a share, go to commercial bank. It's one of the companies that pay high dividends on their shares. So you can go to commercial bank, they will show you the process. But there's a minimum number of shares, maybe 1,000 shares or 2,000 before you can be. You can go there. One share is 60%. Say we are buying 2 shares. I'm 3. They need money. If they are buying the shares, the shares give them money. So maybe 2,000 shares initial. So that people have about 10,000, 50,000 shares in company. Because the more shares you have, because the company is going to declare a dividend, but you are not working, you are just there. Whatever profit the company declare, they are going to declare a dividend on the share. So say dividend per share is, let's say, 80 pesos. Some people are in Ghana here. That's what they do. They don't do any active business, but they are getting money. Just buying share, but it's a risk. It's a business. So if you buy, let's say if you have 50,000 shares in a company and the company declare dividend of, let's say, 1 CD per share, that means the whole year multiply 1 CD by your 50,000, automatically will credit it to your account. Now your capital is there, your share value is there. Later you can sell the share and get that money. So it's an investment that people do. Now you can also go to Farmer Ghana Limited. Farmer Ghana Limited was paying the highest dividend as a 3. They pay a lot. They have done that. When you go to the Ghana Stock Exchange. So the best place is visit Ghana Stock Exchange. When you go to the stock exchange, what they do, stock exchange do is that you will see those who have company shares that they are no more interested, they need their capital. And one thing is that when you buy the company shares, let's say you will spend now, let's say 20,000 Ghana cedis to buy shares, let's say in commercial bank, maybe you buy 50,000 shares, like 50,000, mark 50,000, but the value is 10,000 Ghana cedis. So the Ghana commercial bank, what they do is that they will give you a certificate showing that you have bought a share worth 50,000 of their shares. The value that you pay 10,000 Ghana cedis. They will document everything, give you the certificate. So you are sure that your account detail everything, where the dividend should be paid to everything will be collected. So you are a shareholder of commercial bank. Now, when you are a shareholder for commercial bank for let's say 5 years or 10 years, and now you think that you want the 10 you want your capital back. You are no more interested. You want to maybe you are going to travel, you're going so you want to stop being a shareholder of Ghana. You cannot go to Ghana Commercial Bank anywhere like UCC, go to Ghana Commercial Bank and the bank inside. I want to see the manager. The manager, I want to now. I am a shareholder. Your shares 50,000 now. I want to stop. So these are your shares. Collect it and give my money. We don't do that. It's never done. Where you have to go is go to the stock exchange. You will find people who call brokers. Stock brokers are there. People, they are stock brokers. All they do is that they monitor the stock exchange. Those who have sell companies shares that they want to sell, and those people prospective like you, potential who want to buy companies that they also do. So that is broker. That's what they do. Looking for people who want to buy shares and looking for people who want to sell shares. Do you know what I say? You see the broker, oh, I have 50,000 shares of commercial, I want to sell. Okay, I'll sell it for them. They'll take it. If I sell my commission, I'll take 5% or 20% of it. Okay, then they will not also look for people, then they trade for you, then they change the documentation, then they get your money back to you at a fee, but you lose something because the broker will also get a commission, but still you get something. So then you cease to become, then you transfer the share holders are now transferred to a new holder who is now the share, and the dividend will pay to that person. In that's how we do. So stock exchange, that's where people trade shares of a company. So when you talk about Ghana Stock Exchange, if you want to buy shares, go to the Ghana Stock Exchange. If you want to sell your share, go to the stock exchange. You get people who want to buy and those who want to sell. That is it. I don't know whether this information will help. There are so many companies that you can buy shares. But the stock exchange will help you to know. When you go to the stock exchange, they also rank those who pay the dividend that they pay. Maybe this company, ABL Ghana, or maybe MTN. Last year they paid dividend per share, 40% per share. Or maybe this company, they do that kind of listing for you to see, oh, okay, then I want these companies paying high shares. But the thing is, do you have somebody who wants to sell the shares? It's not always that the company also sell the shares. There are times that they float, and when they float the shares, they make general public for people to know we are selling our shares. So those who are interested, and normally when company needs money, that's when they float shares. But if they are not selling the share directly from the company, you can buy from existing shareholder who is selling their shares on the stock exchange through a broker. Anyone? Are there more questions or we can move on? My fellow accountants. So now you have core accountants. And there's some in our accountants. We have got chartered accountants. For instance, you haven't got no register, you can write. My fellow CA, chartered accountants. You are also the class of June when you be say, so yeah, accountant. Madam, why? Okay. So now let's move on. Now that there are no more further questions, we are not breaking. Sir, we are doing up to 11, right? But we're supposed to be break, right? Course reps. Hey, won't you mind me again? Why are you tired?
Yes.
No, we
What's
are
that?
listening.
So we will not break, but let's do up to. Say how many minutes break do we have? Or
10
there's no
minutes.
break?
10
Huh?
minutes. 10
10 minutes break.
minutes. Yes, please.
The 10 minutes what the bed. If you'll be at 10 minutes, we will close 10 minutes earlier. Then you chop that break. Yeah.
All right,
Okay,
Doc.
let's continue. So now I want to bring another. Let's look at the double entry. Now that we have learned the principles and that, we can now go into the double entry proper. So I'm bringing another concept. So if you want something to be clear, this is where we need to clear it. Now we are going to the calculation. We are now coming to start the calculation. So get your paper, your pens ready, and the rest. And let's see how it goes. Foundational accounting. Now let's look at double entry. Okay. Double entry principle. I hope it's showing the screen.
Yes, sir.
Okay. So double entry. In fact, if you really appreciate accounting, or if you really want to understand and enjoy accounting, it is this. It's a foundation where you can do manufacturing accounts. Please hold on. 4 to 4. Hello, Prof. Prof. Dabio. Well, now I'm so called Brazil. I'm called Brazil. And then there's the last McDonald. I'm called Brazil. That conference, I'm called now. I don't know. More Brazil. All right. Oh, I'm more Brazil. I'm a few cram excited. Are you for fish for? All right. Martin McCarthy. Bro. I think I'll be Bye. Okay, sorry. I'm back. So let's talk. Double entry. So there'll be a depend. Why? True or false? True.
False. False.
True.
Who said false?
False.
Double. Okay, double. You understand double, right? Double means what? The person confused. Double means what?
Two.
Two things.
Entry means what? To enter something in our
All realm.
Oh, not that big accounting. Yes, your room. Accounting to end. Hey, madam. Accounting want to enter to record. Record. Yeah, you are. Yeah, I think it's a generic entry. Me, yeah, you are entry, but you are here. We mean entry in accounting or enter means record. So double entry, that means record two, recording twice. That's when anytime you hear double entry, it means that to enter something in the book means to record, but record it twice. So that principle, theory of double entry means what makes us record transaction twice. Every transaction, that is where we are going. So we have already talked about this duality of accounting. That principle, we are now coming to apply it in principle. So like I said, in every business or in the double entry system, every business transaction affects the balance in at least two accounts. Accounts are drawn for each element. So there are two accounts that are being affected in double entry. So to the accountant, we see that every transaction, there are two sides. There's a debit side and a credit side. Now, for the purpose of those who are first doing accounts, when you talk about accounts, this a big T. When you write something like this, a big T like this, it's an account. This is how we denote it. So if I say open cash account, you just write like this and you write cash here on top account. This becomes cash account. Sales accounts, you write this is sales. Right? So accounts is denoted by that a big T like this. So that is account. Now when you have accounts like this, there's always two sides of the account. You have what we call the debit side, and we have the credit side. Now,
Please,
the
I can't
debit.
see the drawing.
Oh, it's not showing. My screen is not showing.
Yes, sir.
Please, it's showing, but the diagram.
The drawings on
The drawing is what we are talking about.
Yes.
It's the diagrams
Oh,
are not
okay. Let me use.
The background is not allowing the drawing to show.
Yeah, let me use different background. You must why. Let me see if I can get. Okay. You want white background, right? Let me use something like this. So this one you can see.
Yes, sir.
Okay, you let me. But for me to get the pen, this the pen. So I'll try. I'm saying that. Where we are. Let me use this piece. So this is why I was talking about the debit. Let's assume that there's an account. I hope you see the diagram on the board.
Yeah.
So it's like the diagram.
Yes, sir.
The diagram is like this is the same thing I'm doing here. We have T and we have the name of the accounts. So the name of the accounts, you have to write, let's say cash account. So let me say that I write cash here. Cash accounts. When you have the accounts, they have always two sides. We have what we call the debit side.
Please, there's a music. There's a music on your background.
Yeah, Henry. It's from Henry.
It's not me. Somebody's
Are you?
It's who?
Someone is unmuted.
Henry.
I think he has muted. Okay. So now, whenever you have any accounts, remember that there are two sides. There's what we call a debit side and a credit side. Now, the debit side is the left-hand side of the accounts. This side. The debit is the left. And that one records the debit means record a transaction at the left side of the account. Credit means to record the transaction or enter. See the word enter meaning what? Record. So here enter in enter means record. So the term credit means enter the transaction or record the transaction at the right side of the accounts. So when you talk about accounts, anytime you write T, big T, it's an account. So this big T, this is an account. Then write the name, maybe bank accounts. Now, the debit, so you see that you have a debit here, and we have a credit side here. Then you see that look at the date. You have date, you have particulars, ledger folio number, then the amounts column. Then after that, there's a line here. This is another, this is a line. So this becomes this like the same as T account. Then you start another side here, date, particulars, ledger folio, the amount. So if I bring it to what I have drawn here, the debits, you can, it's not always that you have to write a debit in words like this. Standard acceptable is debit, DR. So when you do DR, this is the debit side. Then CR is also credit side. So if I take this as bank accounts, we have debit side here is the debit. And this side is the credit. So in normal calculation, you don't worry yourself. When you open the account, don't worry yourself with this heading. You write where the date and the particular, you don't write the heading. All you need to write is bank accounts. Then the date. So if you are making the recording, let's say 25th October, that's all you need. Then you write maybe cash. Then the amount 300. That's all. You have specified all the things there. You see the date, you don't need to write the heading date before you write. We know that the first thing you need to have to record is the date. So the date, you put down the date, then the particular. The particular is what you are writing. What are you writing? Is it narration cash? Then the amount. After ledger folio, leave it. Then cash. That's all. You have finished. So when you are making recording in the accounts, the date, then the transaction, the particular, then the amount. These are the most important things that the ledger folio is a reference. Sometimes when we go to proper office, there's a cash book ledger that there are reference numbers, so for easy referral of the item. Oh, this one, let's go to ledger folio 1 or 5 or 25. You go there and see the details of the transaction. So, but what we are coming to do here, what we need is this: always record the date, then the cash, the transaction. Particularly, it can be cash, it can be furniture, it can be building, depending on whatever we are using the cash to buy. So we will record then the amount. Now, when you do this, it means that the transaction is recorded at the debit side. When you record it at this side, is every account you can record transaction at the debit side or the credit side, but it depends on the transaction, the statement. So this particular bank account, I can give a statement that will make the recording being recorded at the transaction. We receive a check from Ben, 3,000 Ghana cedi into our bank accounts. This one, we receive, because the company receiving, the cash is coming into the bank. We have to record it at the credit side because we are receiving. We receive. So when we debit or record transaction at the debit side when we receive. So inflows are debited, but we credit what goes out. So we want to say that debit what comes in, credit what goes out. And that's why we call debit the receiver, credit the giver account. For now, debit the receiver. The principle is debit the receiver, credit the giver. So the account that is receiving is always debited. And I say to debit, we record the transaction at the left side of the account. The account that is giving out is always credited. Credited means record the transaction at the right-hand side of the account. This is the basic fundamental thing that you need to understand before we move on. Debit inflows So inflow is what comes in, and we credit what? Outflows. So all inflows are debited, all outflows are credited. Please, do you understand what I'm saying? Is it clear before I move on?
Yes, sir.
Good. Now let's move a bit further. So double entry rule for element of financial statement. In fact, there are elements of you see sometimes the rule you have to understand. See, double entry rule for element of financial statement. We have double entry rule for assets. When we are recording assets, we debit what comes in and we credit what goes out. So that is straightforward. Debit increases in assets. So whenever we buy assets, if the asset is increased, to show that there's an increase, we record it at the left hand side. So enter increase in assets amount at this side. If there's a decrease, enter decrease amount here. For example, so if we have, let's say, motor vehicle, let's assume that this motor vehicle. If we are buying motor vehicle, the reason why we debit, assuming we don't have motor vehicle, so let's say this account is motor. Let's talk about motor vehicle. Let's say a car, any car comes a motor vehicle. Let's assume that now is zero. But this year, the company is going to buy a motor vehicle at a cost of 3,000. Now, the company, don't forget that cash account. So you open cash account like this. This is a cash account. We are going to buy, so you have to take money out, 3,000 to the market. So cash accounts, we are going to credit our cash account 3,000. So you see that cash will go out to the market. We are going to give the 3,000 to somebody. But when you give the 3,000 to somebody, we will bring in home an asset. So our assets will increase. So when we come here, we will say a motor vehicle cash. Cash is helping us to get a motor vehicle worth 3,000. See, so this is double entry. We have completed a double entry. We have recorded a transaction twice because in the cash account, we have credited cash 3,000 and we have debited motor vehicle accounts 3,000. So there's a debit and there's a credit of equal amount. This is how we do double entry. This so that we have bought. So when we look at a motor account, see that cash, it means that we have bought a motor vehicle worth 3,000 using cash. When you come to cash accounts here, we write motor here. Motor. That's the particulars. Always the particulars will tell you why we are using the amount for. So there are motor. Everybody know that okay, once you have motor here, 3,000. And when it comes to the motor accounts, you see cash, 3,000. It means that there's something between them. We took cash of 3,000 to buy motor of what? 3,000. That is what this thing says. So we have debit the receiver, the motor account is receiving, and we have credited the giver account, which is cash account, that have been credited. How we understand this?
Yes, please.
Yes, sir.
We are going small. We are starting out. Now, so that is that for all assets, whether motor van, goodwill, patent, inventory, stock, debt, every asset, you apply debit the receiver. What comes in is debited. What goes out is credited. So that is so cash is also an asset. Don't forget, cash is an asset. But if it's going out, we credit it to decrease it. So it means that if you have, let's assume that we have 10,000 cash at our balance. Now we are reducing it by 3,000. So that's decreased. When you record 3,000, you have decreased the cash by 3,000. So when you balance it, you left 7,000. But so we are decreasing one asset and increasing another asset. That's how it is. Yes, somebody raise up my hands. Ask your question.
Sir, please.
I'm listening. Are you there?
You money in your bank.
I didn't hear anything. Start again. Your question.
So, I was saying that, for example, if you receive money in your bank account, it comes as your account has been credited with a particular amount. So I would like to know that you are receiving, but it comes as your account has been credited. So I want to know the difference.
Okay. That's another thing. That's when we are doing. Let me explain that. You see, how you call bank statement. You see, when you see money into your account has been credited with some. You see, the bank is because of double entry. You see that that's what we call bank account. So let's say bank. Did you see what I'm writing? Bank.
Yes, sir.
How you see the book bank account? Have you seen that one?
Yes,
Yes, sir.
yes, please.
So normally the bank accounts, you the owner, the person who is the bank is an asset. Bank account is an asset, and all asset has to have debit balance. Now there's what we call bank statement. It's different from bank accounts. The bank statement is what is held for you at the bank. The bank that you are so statement. That one bank statement is not an account, but just a statement that have things like this. You have debit, you have the bank statement. When you go for your bank statement, you can have something like particulars here. Then here is debit, and here is what credit. To bank statement. So the bank they keep your statement showing transactions, showing that the amount you have received and that credit. By you as individual, you have the bank account. Maybe if you're a businessman, this is how it is. In your house, you have bank account, which you have your cash book. So when you are going to put money at the bank, you are going to put money in your bank account in your house. What you do is that your cash book that is with you in the house, bank, you have to record that today, 25th December, I'm going to deposit money at the bank. Deposit, let's say 1,000 Ghana cedis. You have to be here because the money is not going out to anybody. It's not that you are going to use to pay. It's money at the bank that you are going to increase it. So you have to know that for your bank account, you are going to deposit. So in your cash book, bank column, it has to be debited because it's increasing an asset. So debit here. When you take this money to the bank, when they receive this money, because of double entry, they cannot, if they debit it, it means that they are reduced because they have to work credited. So it will be credited at 1,000 because you have already debited this 1,000 in your cash book. Your bank column has already been credited 1,000. So when you open your bank book, your bank column, bank cash book, no, your 1,000 Ghana cedis without even going to the bank, you should know how much you are having. The next day, I'm going to, so the bank, they have the cash book, the bank statement have particulars, debit, credit, then balance. They have balance. So now your balance is what? 1,000 here. Now you have a balance column 1,000. The next day, let's say 2 days time, we are going to put 100 Ghana cedis. You have to record here 100 Ghana cedis. So 25, you deposited this, and now the 100 account. When you take this 100 to the bank they will receive it on your behalf. It's just a statement. They will say, okay, they are going to add 100, credit your account with 100. But now your balance is going to be, show your balance of what? 1,100. So when you go to the bank, I say, I want to show, what's my balance? They just open your statement and they look at the balance. Go, oh, you have 1,001 here. Oh, okay. In your cash book at home, debit side, you have to also have 1,000. So always the double entry, because of the duality of transaction, and they have to be opposite sides. Every transaction involving money has two sides. You cannot say you have debited here, the bank will also debit. Debit, which is value the double entry principle. So once the cash book is debited, the next corresponding entry is credit. And the same thing. So as you take money to any money that comes into your account in your name, the bank will credit it. Because if somebody pay the money into your account without your knowledge, because you don't know, the bank will receive it. It's coming to you. They will credit it to your account because they know that obviously when you see it, you are going to debit it to your what? Bank money to increase your asset. Your asset is increasing bank balance. So when anytime you see it, you are going to what? Increase your bank balance. That's why when the money is paid to your account, the bank will credit it because it's an asset to you, and your bank balance in the house is going to increase by the amount that the bank has received on your behalf. In the same way, if you are going to take money, or you are going to pay, or you issue check to somebody, or you are going to withdraw money, let me go and take 200 Ghana cedis. You see, decrease in assets always record at what? Credit side. So you are now going to decrease your assets at the bank. All decreases are recorded at the right. So when you record 200 here instead, you are going to reduce your bank balance. So cash out. This one is like you are paying issue money. So your 1,001 is going to reduce by 200. So you take this check to bank. The bank, they receive it. But this time when they receive it, it's not money you are going to bring. But the money that you have, you are coming to take to it. They will debit your accounts. This time, they will debit here 200. When they debit your account to it, they will go to the balance and say you have 900 balance left. And it is that. So anytime you take money to the bank to deposit, they will credit your account with the amount because your card book at the house has to be debited before you bring it to them. Whenever you go and take money, you credit your cash book, and now your bank statement will be debited. So at any point in time, the debit side of your cash book balance should be corresponding to the credit side of the bank statement, and the vice versa. That's how we will do cash book proper. When you get to a cash book, you understand the bank, and that is how. So this is the reason why your accounts is credited at the bank and not debited. How this one will help you understand something. Is that okay?
Thank you, sir. Yes, sir.
Is it clear? Are you sure?
I'm okay.
Huh? Madam, now small, madam, small. I hope you were following.
Sir.
Because so that sometimes people always get confused that if you say debit, why is that money? So you are kind of
Exactly.
Sometimes you have a debit balance. When school fees, you say you have a credit balance, and you are confused. This is a double entry. So now that's why I'm explaining that. If the bank say you have a credit balance, it's a positive figure. But when you have credit balance at the bank, it means that you have positive. If it's school fees and you have a credit balance, that means they are owing you. But if you have a debit balance at the bank, it's a negative. But if it's a cash book and you have credit balance in the cash book, that one is not good. But you have a debit balance. It is like that, double entry. So the bank statement is not accounts, it's a statement. So the credit balance in your account has been credited. If you look at it from the point of double entry credit, you say, hey, I say my account. No. Once your accounts have been credited, we are alert your accounts, commercial, your account have been credited with so much. Now you're massive. There'll be any moment better. If your account been debited, that one reducing your balance at the bank because of double entry. They can't have debit, and you can't have credit. So once it's an asset and it's going to increase your resources, the bank have to credit it. So that's understand everything. That's a myth. It's a way. You see, learning is interesting. It's not interesting. At one point we were talking about this, and they say so if you don't understand, sometimes this can confuse you. Because you are teaching the students, say, madam, you are saying that debit and credit, you have explained debit and credit are fine. Debit what comes in, and credit what goes up. I have understood this one perfectly. But why is that bank money comes in they receive. But don't forget that the bank, they are receiving on your behalf. They receive it. But the money that they are receiving, they don't debit me, but they credit you. That's a nice question. But as a madam or a teacher, use the double entry to explain to the student that, okay, it's like you have two accounts. The bank account, the cash book, and that one is with you in the house. And the bank statement is at the bank. The bank, they are receiving it on your behalf. But because the double entry has to always be certified for every transaction, debit, credit, and it should be opposite side of the same amount. So if the bank receive the money, they credit your account because you are going to debit your bank accounts in the house. So it's an increase. So you are going to debit it, obviously. It's an asset. So you are going to debit it to increase your bank balance. So the bank has to credit it. The same way, if you are going to reduce or take money from bank, you are going to credit the bank side in your cash book in the house, which will reduce your bill. And when you come to the bank has to debit your statement to also reduce your bank. This thing is double entry, but you cannot use the same idea. So that is what you have to say. But there's a liability. For liability is opposite of asset. If liability increases, we credit it. But if it decreases, we debit it. So it's opposite. Liability, loan. Loan is a liability. So if you have, let's say this is commercial bank loan accounts. So loan. Today you took a loan of 1,000 Ghana cedis. So here it's not an asset. See, the loan, the reason why the loan account is going to be credited is that it's a liability. The loan that the bank is giving to you, when they give you the loan, you have bank accounts. If you understand double entry, you can do everything. This is a bank account that you have. So you go to the bank, they should give you a loan. They are giving you a loan, the loan of 1,000 Ghana cedis. They will pay to your bank account. So your bank accounts, the loan is the money, physical money that they have paid into your bank. So your bank has received it. 1,000 Ghana cedis here as loan. The loan comes with it. And while the loan has been paid into your bank account, the bank has received it in your bank account. Debit side, you have been given. The next correspondent is credit. So loan facility or liability, you credit your 1,000. If you are going to pay off this loan to the commercial bank, you can go and say, I'm paying everything. So go to your bank account, pay the loan, and issue a check, 1,000 Ghana cedis. So you have paid. So now this loan, once you pay 1,000, the loan has cancelled. As soon as you pay, the money is going, when you come here, decrease, now the liability is going to reduce. Your obligation is going to reduce by 1,000 because you are paying it. So you see that 1,000 will be here to cancel your liability. So whenever there is a liability, if you want to increase it, we debit it. If you want to decrease, we debit it. If you want to increase it, we credit. But when it's like this, you don't understand unless you use figures. So let's go and use the figures to demonstrate all this capital and this thing. So when we use the figures, now as we go, we'll explain it first. So let's start with our first illustration. Before that, let me open the floor. Do you have questions, comments, contribution report? So now we are going to start calculations and other things. Recordings in
Is
the
the rules for the liability again?
the what? You say what?
Rules for the liability was confusing.
Oh, liability. It's just opposite of asset. You see the asset, to increase assets, we record it at the debit side. And to reduce assets, we record it at the credit side. That was asset. But liability, if you want to increase liability, you record it, the increase is at the credit side. But if you want to decrease a liability, the decrease is at the debit side. And I just use the loan facility or supplier. Let me use another one. Let's say trade creditor, supplier. Let me use this one. Liability. Look at something here. You want to purchase goods on credit. You bought goods on credit. You didn't pay from bank. So there are two things. Once you buy the goods, you know that you have purchases accounts. So let me open purchases accounts here. Some of the accounting. Accounting, papa. Purchases accounts. Then creditor. Now Ben is a creditor because you bought the goods without paying. So creditor accounts, something like this. Now you bought the goods, how much? Let's say 200 from Ben, a creditor, without you paying it. So Ben has given you the goods, you have brought it. So you see that the goods, let's say, let me use goods. Goods, 200 in your purchase is 1.1, so 200 is here. But Ben has to be credited because Ben, the creditor, he gave you the goods. So goods is here. 200. This is a liability you need to settle. 200. You have not paid this one. Let's say 3 days later, you went to buy another goods, 50 cedis from Ben. You didn't pay. So now there's another liability that has come. You have to increase the liability. It's a liability that means you have not paid. So another goods. So here, you bought the goods, another additional goods of 50. So let's say he has given you 50 cedis, but you have not paid. So your liability is increasing. How do you increase it? You record it at the credit side of that account. So you see that now your liability can acquire 250 of what amount and the amount 250 you have not paid. But if you want to reduce the liability, assuming you are going to pay, let's say you are going to pay 1,000 Ghana cedis, or maybe you are going to pay 200, so that your liability will be reduced to 50. You are going to pay 200. You can now say that cash, you are going to pay Ben. Let's say, if this is a cash account, let's say you are going to pay 200 cedis. When it comes here, then consider that you are going to pay the person 200. You are going to reduce your liability. So when it comes, your liability has to reduce. So to reduce liability, it is always recorded at the debit side. This 200 will now cancel the 200 here. So leaving only 50 cedis outstanding. We will do proper recordings for this. So let's go. As we go on, you do some of these things and you understand. Madam, is that okay?
Okay, sir. Thank you.
Don't worry, it shall be well. Okay. Fellow accountants. Now let's start. Now, record transaction. The cardinal rule in recording transactions is that, and this one there you get under my exams in advance. Where there I'll give you series of transactions like this, and I'll ask you to pass the entry into the and then I'll be I'll give you transactions and you do the half a double entry. But the question, you will not know the item that will come. And it doesn't matter, but there are rules. So when you are recording transaction in double entry, there are rules. The first thing is that read the transaction. When you read a transaction, the second thing is please identify the 2 accounts or 3 accounts that are involved. Let me say identify the accounts that are involved in the transaction. Every transaction, so far as accounting transaction, there will be 2 or 3 accounts. There is no way you can have a transaction only 1 account. No. Read a transaction. There are always 2 or 3 accounts that are involved. Identify the transaction accounts that are. So first one, you take your time, read a transaction. The next step is identify the accounts that are involved in the transaction. Then the next step is determine or decide. Try to decide which account is receiving something and which account is giving something. That's the next thing. Once you're able to say, oh, okay, there are two accounts. These are the two accounts involved in this transaction. Okay, between this account, which one is giving out and which one is giving out, receiving? Try to determine that one. Once you're able to determine which one is giving and which one receiving, you are done. The next thing is debit the receiver accounts and credit the giver account. Because I've already explained to you what it means by debit and what it means by credit. So now you have identified the accounts involved. You say debit the receiver and credit the giver. Debit means record the asset amount at the left hand side, and credit is what? Recording at the right hand side. So let's use this analysis to start with this basic one. So now, those who have done accounting before the cry can close your eyes and ears for it. This one is for those who have never done accounting. Madam now, management for now. Account. Those who have done accounting, I know say you don't need this. You know it already. So you can close your eyes and leave it for the beginners. Okay? Is that not true?
True, though.
You don't know that if you say it's true or not. Because no other time. I said, oh. Okay. So let's go step by step. This illustration, we should determine the account to be debited and the account to be credited in the following transaction. So this transaction, first one, started business with cash, 200. Now, when you see started business with cash, 200, how many accounts? The first thing you have to read, so I read it. Started business with cash, 2,000. How many accounts which accounts are involved in this transaction? That's the first. When you finish reading, the next thing is determine the accounts. Tell the accounts involved. Yes. What are the accounts?
We have capital account and cash account.
Good. Capital account. Somebody say, I say capital accounts be our danger. Also capital account. The capital account is coming because in business, the initial amount of money that everybody used to start a business is called capital. So that one we will not tell you that capital. You have to know as accounting student. So you see, this transaction, this A transaction, once you read it, as soon as you read, somebody started business. The word started business is bringing the capital accounts, capital here. With cash, cash is clear. So there are two accounts that are involved. So I see, first we read it, second we determine the accounts. So we know that we have capital accounts involved. Then we have cash accounts. So you have opened the two accounts here. Simple. The next thing is once you determine the two accounts involved, the next step is determine between the two which one is giving out something and which one is receiving out something. So between this, which one is receiving and which one is giving? I want a lady to answer that. A lady.
Capital is receiving and cash is giving.
Look at it where why should I capital is giving? Started business with cash, 2,000. Why do you say capital is receiving and cash is?
Please, capital is giving and cash is receiving.
Why? Why have you changed your mind? Yeah, I always wonder why you accounting don't be interested, always interested in why. Why you have to understand why you are doing what you are doing. Why do you think, okay, someone should help? Why do you think capital is giving? Yes, capital is giving and cash is receiving, but why? What shows? Why are we doing that? Yes, anybody who wants to explain to us why? How can you know capital is given and cash is received? Hey, nobody.
Let me try.
Okay, try. Somebody's microphone is on.
Yeah, the capital is a form of liability that the owner has given to the business.
Yes. You see, the business entity concept that we talk about, I explained that capital is always, and for the business entity concept, this cash is a business cash account, but the capital is the owner who is pumping this one to the business. So capital is always initial amount that we use to start business, and that means the owner who give it to the business for the business to establish. So always capital can never receive. Always capital is always given. So now that we know that capital is given and cash is what receiving, what do we do? Yes, madam. Now capital is given, cash is receiving. Apply the double entry principle for me. Madam, small. What should I do?
So the giver will be debited.
No.
And the giver will be credited. And then the receiver will now be debited.
So this is generic. I don't understand debit and credit. What should I come to my level? What should I do? Use the figures. Use the 2000. What should I do? Use account. Let me so what do you mean by debit? So how should I record it and the rest? So say when I come to the capital, what should I do? Oh, you don't know what I should do. Okay, who is helping me? What should I do? Tell me what I should do.
Please, can I talk?
Yes, go ahead.
I think on a capital account, you go to the right side. Then you record cash 2,000. Then the cash account, you go
Which side?
left.
Okay.
Capital, the right side.
That's
Right side, that's the credit.
So here.
The right side.
Here. 2,000 here.
The capital right side, 2,000. And the cash left side, 2,000.
Good. So the madam who said debit, that is why I want. So you see that debit, credit. That means the giver capital is given. So this means that we have credited capital. Cash is receiving. This means that we have debited cash. So you credit the giver, debit the receiver. Now there's another thing. When you are in one account, you have to write the name of the corresponding accounts in this account. So you cannot say that you are in capital accounts. So here you have to write cash. So the date have to come first, but I have not given the date. In the rare question, we'll give you the date. So in the date, you write the date here. Then the next thing is, if you are in capital, the capital account, the transaction between capital and what? Cash. So when you are here, you have to write cash here. So cash. You have to write cash in capital account, 2,000. Then when you come to the capital account, cash account, you write capital in front of the figure. So that anytime we look at it, we know that this money is coming from capital. So you see, that's how you record a transaction. So you see that once you have capital accounts and you have cash accounts, when you are the capital accounts, credit side, cash. Yes, ask your question. Ask the question. Someone wanted to ask question. Oh, okay, let's move on. So when you are in capital accounts, you write cash in front of the figure. Now when you come to the cash accounts, you write capital in front of the figure, the same amount. But this shows that whenever we look into the cash account, so we receive 2,000 from capital. That's why the capital is here. When you are in capital accounts, we can say, oh, we gave 2,000 to our cash. So always remember that when you are in one account, You got to, so that is what I've been done here. So you see, look at it. Very simple. Started business account 2000. I'll give you this slide so that you'll be reading through. I'll give you the slide. So you see that capital accounts, when we are in capital cash, credit it. You are on the credit side. When it comes to cash accounts, then you debit it in the name of capital. Very simple. Is that okay?
Yes, it's okay.
Now let's go to
Please.
transaction number 2. This one, I want all of you to do it. Yes? You want to ask question? I want everybody to do it. And when you finish, I'll call random. This one I'm going to call, your names are there. So I'm giving you 2 minutes. Everybody do it for me. 8,000 Ghana cedis cash into business bank accounts. So everybody, use the principle. Read the transaction, identify the 2 accounts involved, determine which one receiver and which one debit the receiver, credit the giver. Do that one, everybody. 2 minutes. I'm giving you 2 minutes to do that. When you finish, I'll call this one, I'll call names. So if I mention your name, then you tell me how you have recorded it. So your time starts now. Open the transaction.
Paid
Open
8,000
8,000 Ghana cedis of cash into business bank account. To do it. And I'll call a lady. I know I'll call a lady. The names are here. See the names. Everybody is here. I wish you can share your screen for me to see. So you can even share, but you don't have this. If you can share. Okay. I think by now you are done. So baby.
Yes, sir.
Now,
Yes.
okay. So let me see. Nobody should that. Let me call anybody that the spirit will touch me to call. Me, I don't know you. I don't know anybody. So if I call, you don't say that as a man, if you share any my friend. When you say my name too, when you start cry, I don't care. Udina mentioned that friend. Juliana Frimpoma. Juliana Frimpoma. Tell me, are you here?
I'm here.
Good.
Yeah.
I like your smile. The way you are smiling, right? What you are doing in advance. Julie, what take us through? Let me see the cry. 10,000 CDs over. So tell us, so now you are the lecturer. Take us through. Everybody listen to her. You don't disgrace me.
Okay, we have 2 accounts here.
Okay.
The cash accounts and bank accounts. So since paid cash into bank, cash is being given out. So cash account will be credited at the right side of the account.
Wait,
then
Thomas.
The bank is receiving.
Let me draw the accounts. So you say we have 2 accounts. We have bank and what? cash, right?
Cash.
Now what do we do? That's right. So now continue.
So cash account is given out. So cash.
Okay.
So cash will be credited.
Like
So
this.
yeah. So bank. So the name will be bank at the
Okay,
right
good.
side. Yeah.
Good here.
Account.
Bank here.
Yeah.
Good. So bank.
Yeah.
Okay. Now you come here.
And then
So cash
it
here.
will be cash. Yeah.
The same amount.
Yes, the same amount.
Good. Good. I hope you all had this one. Is there anybody who had different thing apart from this?
No,
It's the
sir.
same thing. It's correct,
Hey,
sir.
that will be American. You thank God. All got this, then it means that the work is done. That's good. Perfect. So you have record. You see, it's seamless. You are applying the principle. Identify the two accounts involved. Okay. Now we are going to see how to do it. I'm going to call somebody to also take us through that. Very good. So bought motor van on credit from a creditor, 1,500. Record it in the book of accounts. So now we are doing accounting. So read the transaction, identify the two accounts involved, ask yourself between this, which one is giving, which one is receiving. Debit the accounts that is receiving, credit the accounts that is giving. Now you know credit and debit. Left hand side. Very simple. And with this, you can, no matter how deep, don't you just follow principle and you get everything correct. So do that one too.
Please, the question again.
It's the C. This one. What credit from customer or a creditor, 1,500. How you can see the screen?
Yeah. So you debit.
Oh, somebody. You want to answer for it?
Yeah.
Okay.
So you debit the purchases account and
Wait.
the creditors account.
Wait. Let's take it one by one. Thomas. First, you said which accounts are involved?
So we have motor van account and creditors account.
Motor. Okay. So when you say motor accounts, motor then the accounts. Then creditor.
No.
Creditor account. Okay. Now let's go.
So you debit motor van account and creditors account. The amount of 1,500.
So it means that I should write creditor here. And write 1,000.
Yeah, 1,500. Yeah.
Then I come here, I write what? Motor.
Listen, yeah, motor.
How much? 1,500. Okay. This one too, everybody got it. Yeah. Or is it somebody who got something different from this? Yes.
Yes, please. Please, me, I want the accounts to be purchases and credit.
You got okay. You got that. Purchase accounts.
And creditors account.
Good. That one. See, if you bought goods, anytime you bought goods or stock, goods, the item that you are buying for resale, goods, that is when you would have open purchase account. So here you see that when you open purchase, get yes, entry for about the account's name will be wrong. Because if as a bought motor vehicle, they have given you the specific name of the assets that we bought. So you have to open that asset account, motor vehicle account,
Okay.
or motor bank. But if we are not giving you the account's name or the item name, okay, bought goods, that is generic. That's why we open purchase account. But once we are specified motor bank, we have to open that motor bank. That is the only thing. I hope you understand this.
Yes, please.
Okay, good. Thank you. Good. All right. So let's move on. Now I think you are getting it. So all this is what you have done. Motor bank creditors. That is very good. That is the whole thing. Now let's go to the next. This is the same thing. Expenses. I want us to get more serious. Let me see if I have. All these are small. Accounting equation, but okay. This one I'll give you this thing to read on that, but want something like that. Let's record this one. But before that, it's a small one. I think now your understanding will help you. Your understanding of what we have done, you can record assets, you can record.
Yes, come again.
Huh?
That guy.
Always you have to. Okay, so double entry rule for element of statement of financial position, like losses, expenses. This one we will not worry ourselves because now in general, all that we have done. So when I give you the slide, you can take your time. Whenever you are doing expenses, purchase and sales, apply that same thing. Debit the receiver. So we see here, purchase goods for cash, store goods receiving check. Okay, let's do this one just for something. So when we say purchase goods for cash, what are the two accounts involved? Now let's do it already. What are the two accounts? Go ahead.
Purchases and cash account.
Good. So you see that here we purchase accounts and what? Cash accounts. Now purchase goods for cash. Meaning that don't be confused by for cash that you are going for cash. That means we bought goods and we pay cash. So cash is given, right? And purchase is what? Receiving. I hope you all understand that. So you debit purchase account and you credit what? Cash account. Now that's our second one. V. So goods receiving check. Yes. What accounts are involved?
Sales account and bank account.
Sales account and bank account.
Okay, hold on. Give me a minute. Just hold on. I'm coming. Okay. Yeah, I think you are doing well. But now sales, we are done with that. Are you finished with the sales?
Yes, please.
What and what? Yes. What happened? Explain to me. What did you get? Which accounts? The B.
Sales account and bank account.
Sales accounts. Everybody. So always once you're able to determine the accounts involved, always read a transaction that determine the two accounts. So here, sold goods will give you what we create what we call sales accounts. Then check will give you a bank accounts. So these are the two accounts: sales accounts and bank account. Now, sold goods for car. Which one is receiving and which one is giving?
Bank is receiving, sales account is giving out.
So you credit sales in the name of bank. So you come here, bank. Then how much is that? That's 600. That means we sold goods. When we are selling goods, the goods will go out, and in return, we receive cash or check into bank account. So you debit bank. Accounting is not difficult. Who's that? Where are you into? Is it not interesting, Madam Small? Is it not principle that we are applying? I don't see.
It is interesting, Mama.
Now then, meanwhile, I have principle now. You just follow it. Just with this, you can record any transaction. Now look at something. Pay rent by cash. Paid rent to that's one your master's in just relax. I'm giving you all the tricks. Just relax. Paid rent by cash. Don't rush. First thing, read. Determine the two accounts that are involved. Then apply the giver and simple. So pay rent by cash. Okay. Pay rent. Okay, then rent accounts. So you open rent accounts. So that's one. Rent accounts. By cash. Oh, okay. You say by cash. So cash accounts. So there. Okay. Now between this rent and cash, pay rent. Which one is giving and which one receiving? I'm paying rent. Okay, that means I have to give the money to the landlord. Okay, then rent, cash is paid. Once you see the one giving, automatically the other one is what? Receiving. Because you cannot have credit. So it means that cash is given. You go to cash, you write rent. I'm paying rent by cash. So you go to a rent account, you debit rent in the name of cash. Simple. Double entry. You are passed, so you can pass entries. Follow the principle. Look at this. Receive commission by check. Okay, everybody, do this one. This one, if you get it, I'll give you my car key. Okay, everybody, do the D one for me. Receive commission by check, 400.
Hello, Doc.
Yes.
I'm ready.
Okay.
You debit bank.
What are accounts involved with?
Yeah, commission receive account and bank account.
Okay.
Commission received account and bank account.
Wait, commission
received account.
Receive accounts. Then bank accounts, right?
Yes, please.
That's correct. Now, you see which one? What do I do?
You debit bank with commission received and credit commission received with bank.
Okay, commission received is here. That's 400.
400 Ghana cedis.
I come to commission received, then write bank. That's what? 400. This is correct. Perfect. But why? Why this? Explain to us. Why? I know somebody, Madam Small, will be confused. I didn't hear. Okay, commission received. Now, you see there with the receiver now or credit. No, it's not confusing, madam.
It is.
You see, so explain, but this is correct. This is correct. The debit bank account credit commission received, but why?
Please, commission received is a gain, and therefore, when it is earned, it is supposed to be credited or written on the credit side of it.
What's that? Explanation, you know.
Okay, let me come in.
Okay, say. It's true that now you have principle that all revenue, all income, and liabilities have credit balance. But the technical aspect is this, madam. The reason why commission receive, rent receive, interest receive. Sometimes when you do double, and this is where when you are going to teach as a teacher, you have to be very careful because you see all this while we are coming when we started double and you see debit the receiver, credit the giver. So by now you have taught them for them to get that into their mind that debit what comes in, credit what goes. So they are following that principle and they are understand all of a sudden commission receive, discount receive, this receive comes in, and now you cannot debit the receiver account even because if you don't take it, they'll be confused. If you apply that same principle here, I debit, well, you might think that the commission received is the account that is receiving, and the same might debit the commission received and credit, and that would be wrong. Now the reason is this: when you are receiving a commission, that commission or discount, receive or interest, it's an activity that is happening. Maybe you did something, you made a sales, or you did something as a sales girl, or you went to buy an item and you get a discount. That commission that you are receiving you are getting money. What you are actually getting is cash. If you get a discount, you receive a discount. You are going to pay money. Maybe you took 1,000 Ghana cedis to your creditor house. I bought good 1,000 cedis from you, and I am coming to pay. I said, come here at the end of the month. But 1 week time, you got me. So you are paying early. So because of that, the 1,000 cedis that you have brought, let me give you 200. Pay 800. So you pay 800. Even though you took 1,000 there, you brought home back 200. That's discount that you are receiving. The discount you are receiving is helping you to get you are getting money of 200. So commission that you are receiving, bringing in, you see like the person did some work, and the work you did, you are receiving a commission for that work you did by check. The people have paid you 1,400 money, Ghana cedi check. They'll give you 400 check as a commission that you are receiving for the work you did. That doesn't mean that the commission receive account that you receive, but the commission you are receiving bringing in cash, money in the business. So here, the two accounts involved are commission receive accounts and cash bank accounts, all right. But the question is, accounting deal with money. So which account receiving the money is going into? That's what we are interested in. So you see here, the commission that you are receiving is bringing in check of 400, which is going to be debited into our bank accounts. So bank has to be debited with the amount of commission we are receiving figure, which is 400. Then the next corresponding, because we cannot have debit. Once you know that the check is going to the bank account, the next one should credit. And that also satisfies the condition that all income, gains, and liabilities have credit balance, and all expenses and assets are debit balance. That is it. So you see, don't be confused by the word receive, but be interested in the activity, what the end result is. The commission you are receiving is bringing in cash of 400. So whenever you see commission received, the interest received, discount received, dividend received, you open those accounts, but you don't debit that particular. They are bringing money. It is the cash or bank that's always debited for commission, interest received, commission received, dividend received. The bank or cash will be debited, but that commission received account will be just credited. It's a income or gain account or revenue accounts. Is that okay?
Yes, please.
I'm trying hard for everyone. I want you to just understand it. So that when you stand somewhere, you know that you understand what you are doing. That's why I'm taking my
Doc,
time. Let's talk about that. Yes, madam.
so see, so where we said paid rent by cash, 200. So paid rent
Mhm.
is receiving and cash
Paid
is
rent.
giving.
Yes, rent receiving, cash is given.
So okay, so meaning
So-
rent will be credited.
No. Rent will be debited. So cash is the rent is receiving, and
Yes.
cash is given. So we credit
Yes.
cash and we debit rent. That's what we did.
So rent will be debited.
Yes, exactly.
Oh.
Rent is an expense, so always all expenses accounts are always debited. At the expense in Kwandia, there's no way to be credited unless it's outstanding. If it's the thing is, that's another trick. If you don't know, if the thing is an expense account, like rent, salary, whatever, electricity bill, telephone, if it's an expense, it's an expenditure we always pay. So cash is always going to go out for payment of any expenses. If it's an income account, always it will be credited, like sales, commission received, discount received, income, because that's income will bring in cash, and always cash will always be debited for that income that we are doing when we sell goods. So when we sold the goods, we are getting money. When we receive commission, discount received, we are getting money. So money will be debited. Then that's how we account it. It's principle. But the best explanation is what I have given you. So here, debit rent will be debited and cash will be credited. Are you following?
Yes, though. Yes.
Am I confusing you?
Yes, please.
Am I confusing you?
Not really.
Not really. I like that. That means there's some small confusion.
Yes,
Not
please,
really. Okay. So I'll give you this material for you to just go and read through. Let's go and read. Now, so that is how for the debit and credit, that is all that we can do. Why we meet next time? There's a list. I'm going to give you more. This one. This. Look at this. The foreign effect of transaction. The foreign transaction related to this. Now, show how the balance sheet will be drawn. By this one, it's not a balance sheet. I just want us to. I want one that I'll give you one that you are going to record the transactions. This is it. This is what I wanted. So I'm going to give this one to you as an assignment. But before that, we have to go forward a bit. For this one, you are going to record from the following data, record in the various ledgers and balance of the account. So we have to do the balance of account before we can do it. But we'll do it. Don't worry. Now let's go to this one. Accounting equation and balance sheet or statement of financial. We have done accounting equation already, so I will not waste time. That's accounting equation. Asset is equal to capital. It can be that's when the owner did not borrow money. But you can also have asset equal to capital plus liability. I don't remember that one. So the first thing is asset equal capital plus. But if the owner borrows money and we have assets, the assets of the company is always equal to the capital equity plus liabilities. We have dealt with this one. So let's go to the equation. So, and we did something like this. You can use this one to prepare accounting equation, the statement of financial position. Which last we did something like this because Monday we are to serious enterprise at the start of business on third enterprise as at the start of business on June 1st, 2010 had the following assets. So you see, we have land and building, the values are there, motor van. So we have assets and we have liabilities and this one. So we are using this one to prepare statement of our financial position. I think we did something like that. So you see that we are giving the following assets and they are giving you some liability also. So the question is, how much was borrowed to finance the business. You see, we want to tell that the owner has certain assets, cash at hand and cash in hand. If serious enterprise provided 350,000 from his private savings, so that means for financing the business, how much was borrowed to finance the business? When you get a question like that, what he's trying to say is that this one had these assets and liabilities have been assets. The company had these assets and the owner's personal money was 350. So how much was borrowed to finance? This one you can do this one simple. Just put the accounting equation. So based on accounting, assets should always be equal to capital plus liabilities. Now you know the assets. So all the assets, list them. You can total them on your calculator. So this is asset number 1 plus 2. Total all the assets should be equal to capital plus liability. Now, what we did here is that asset is equal to capital plus liability. Now they say we should how much was borrowed means how we are looking for what? The liability. So we can make liability the what? The subject. And we can find. So if we want to find this, all that we can say is that we can say assets minus capital will be equal to the liability, and the liability is the amount borrowed. So here, what we are doing is that see the assets have been put into bracket. These are all the assets. This part, this part, this part, this part, this, and it's equal to capital plus liability. The capital is 350. That was given plus the liability. So now what we are doing is that when we sum all this and the assets is now going to be so you see this plus assets is equal to capital plus liability, and the assets plus the liability plus the capital, put everything together. So now because we don't know the liability, you have to make it, you have to find the liability. So now you are going to have something like the assets. When you sum all the assets together, you are getting this, all the long thing here. And it should be equal to the capital, which is 350, which was given in the question, plus the liability, which we don't know. Then you make L the subject. So you send this 350 here and change to minus. So you get liability to be this. So that's it. So sometimes what I'm trying to say that you can give information like this and we ask you to find the capital or the liability, depending on what has been given. So the same thing can also represent it like this. Land and building, these are assets. So you see the same information can be presented. The assets, you can list them, these are assets. These are non-current, the current assets too was listed. So when you put the non-current and the current, they get liability, the amount that was below was this. And that's why I call it back. So then let's look at the effect of transaction. When you talk about effect of transaction on the balance sheet, once you have the balance sheet, the asset that you have, we are going to show whether the assets it will increase or decrease. So the first one, look at something like this. The first transaction, we are showing the effect. Okay. How would the effect, what would be? So the following transaction relate to appear. Show how the balance sheet will be drawn after each transaction. So first one, appear started business with the following: premises, assets, cash. This one, cash in hand. That's so when you go to that one, if you want to do the first one, that assets. This is how the statement: premises, this, cash at bank, cash in hand, this, total, this, financial capital, 180. We didn't mention capital, but you have to know that we started a business. So capital, the owner has to give capital of so much before you can buy this item. So that's why the first statement will be like this. Now let's move on. The second one, if the same thing we want to continue, then on the September 10th, he bought stock on credit from Ampadu at 30,000. So the second statement now, see the premises, everything is there, all right. But bought stock. So now inventory has come, stock has come to be part of the asset. The asset has now increased. Now on credit mean that liability has been created. So the capital is there, but now because you didn't pay and Padu liability, you have to add it. The next one, reduce cash 20,000 from bank for business use. So it's going to remove cash from bank for business use. So this one is not drawing, but it's going to bring money from bank. So it means that the bank accounts is going to, so look at what is happening. This 20,000, we are going to debit cash accounts 20,000, and we are going to credit bank. This is what we call contra entry. It's the same thing. We are changing the position of what? Something. Look at the previous, before that transaction, look at bank. Bank was 50,000. Look at this one. Put this figure in mind, 50,000. Cash in hand was what? 10,000. Look at it. But when we go, next question, we are going to withdraw 30,000 from bank and add it to the cash. So how would that be? So that is, we are going to reduce bank by 20,000. So look at the next transaction. There was withdraw cash 20,000 from bank. So it means that the bank balance, which was 50,000, now if you reduce, we withdraw 20,000, it's going to reduce to 30,000. Now that 20,000 we are going to remove from bank will add to the cash balance of 10,000 that we have it. So now the cash in hand has increased by 20,000, so now 30,000. Still the balance sheet will balance. So that's how we do it. The next one, bought furniture by cash 8,000. So you have to know that your cash 30,000 will reduce by 8,000. Then new item will come. So you see that furniture is now being added to the assets column. But your cash, which was 30,000, will reduce by what? The 8,000. So now you have to show it. So that's why we call effect of transaction on the balance sheet item. Any item will have its effect, and that is how you show the effect. Those that will be added, that will be subtracted. So when I give you the, take your time and go through and see that all the items have their effect on the. Are you following?
Yes, sir. Yes, sir.
Yes, sir. Good. Good. So now we have the ledger and the division of the ledger. So when you talk about a ledger, we have purchase ledger, we have sales ledger, and we have general ledger, and we have other. So we have to add or enter transaction in the ledger. I think that's why I have summarized for you. Identify the transaction to be able to know which account debited or credited. Open the relevant ledgers or relevant accounts by writing, then record the two aspects of the ledger. That's what we have already done. The double entry with the ledger. Accounts is also a ledger. So we can have capital, all this that we have done, they have ledgers that we have opened. So the principle is what we have taken through this already. So first, read the transaction. Second, identify the accounts involved. Somebody's microphone is on. That's why I keep hearing myself. So mute it. Okay. So to enter transaction in the ledger or in the accounts, read the transaction. First step, identify the transaction to be able to know which accounts to be debited and which account to be credited. Open the relevant ledger or accounts involved. Write the name of the accounts on top. Record the two aspects of the transaction in the relevant account using the double entry principle. This is the summary of all that. Yeah, that's all with this capital account. When you do that, it's a ledger. It's a ledger or account. So that's what we have been doing so far. And I think by now, so the process of balancing of accounts, this is the last thing that we will do before we end for today. How to balance an account. How to balance accounts. Now, okay, no, this one that it involves so much. We have to do something before we can understand this very clearly. So because there are processes involved. How to buy? There are processes involved. How to compute the values for find a different. That there are a lot of establishing credit balance sheet and grants BD. And I think now you are tired, and I'm also tired. 4 hours talking is not easy. I think it's 11, and I am tired. I am a human being, so I'll reserve this one for another time when we come. But let me see something. Go and do this. Go and do. I'll send a slide. Listen.
You don't like the food. You should take another rice.
She doesn't like the food. I don't like the food. I don't like that food. So change it for me.
Forgive me.
I don't like it. I don't like the food. Change it for me. Okay. So you see, I'm going to give this one to you. Assignment. Do the first part before we meet again. And send it to me. Now when you finish, do it PDF. Just do it on a sheet of paper. I just want you to do it on a sheet of paper. Don't type. Don't worry yourself. Type. Just write on rough way. When you finish, just screenshot or something and send it to me. Write your name on top. Write your name. Maybe Ben. Or write your name. If you have index number, just write it. Write it. Do it on a sheet of paper, A4 sheet or maybe, and just screenshot and send it to me. I want to get your solution before next week. So when we meet, we will balance the account. But the first part, record all these transactions using a double entry in the ledgers. So go and try it. Just do the first part. Record in the various ledgers or accounts. That's the whole thing. Don't balance them. Leave the balancing side. When we meet, you do the balancing. But just do the recording. That's what we have done today. Started business, bought furniture, pay rent, cash sale. Those everybody do independent work. Don't compare answers. I want you to do it as how you understand it and send it to me. Is that okay?
Yes, sir.
Yes, please.
That's for this week. So I'm sending. I'll send that slide to you. Go to the last end of the slide. You will see there. Thank you for your time. And let's see. By close of tomorrow, if we meet on Monday, I'll let you know. Monday evening. Or you don't want to meet?
At your service. Well noted, Doc.
So sometimes you have. If I'm free on Monday, maybe I'll let you know. So let's see by tomorrow evening, or maybe I'll let you know. So if you meet on Monday, then we meet on Monday evening, maybe for about 2 hours or 3 hours. We do that. So now, tentatively, our fashion say we can meet on Monday. I said, yes, substance accounts. We said something happy. We can meet. If something happened that we cannot meet on Saturday, then Monday evening. So something, but we can also be doing advanced meeting. Meet on Monday. Then it's a Saturday. It's already been taken care of. I hope you understand what I'm saying.
Yes, please, we do.
So let's tentatively Monday. Let's see if we're able to do Monday too. I say next week Saturday they're not home. Now I do Saturday, so if I'm free, we'll do. So we do. So you have carry forward. That is better. Okay, thank you for your time. So I'll send a slide to your page right away so that you can. Thank you for your time and hope to meet you again. Bye.
Bye. Thank you for
God bless you.
Now go and prepare food for your husbands and your wives to eat. Go and know from morning breakfast and your children. Go and prepare for them. I know this one. People have not eaten. I know you too. You have not eaten. So everybody should go for food to eat. I know some people, their husbands and the children, they are angry. But it's good. Bye-bye.
Bye.
Bye.